the economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago.
The labour market deterioration, if it continues, well, then that could feed and create a downward spiral.
We think the Fed right now is pretty far behind. It's at a very restrictive level right now.
They are ridiculously behind the curve, irrespective of what the capital markets are doing.
The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you all to the weekend and fast. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. What a week. Monday, the worst day for stocks since 2022. Yesterday, the best day for stocks since 2022. We've all been whipsawed left and right, up and down, all around. It's been vicious. Check out the scores this morning. Equity futures on the S&P 500 a little firmer, up 1/3%. On the Nasdaq 100, up 0.4%. Last week, the data was bad. This week, the data was better. Next week, the calendar's stacked. Danny Berger, let's go through it. August 13th, PPI. August 14th, CPI. August 15th, retail sales. A week later, Jackson Hole.
If that's the kind of data we have next week and we move to such a huge degree on claims, it's kind of worrisome. The fact of the matter is that we are just down 0.5% on the S&P 500 for the week. And Neil Dutta lays this out. It shows you that the risk is asymmetric going into next week's data, that we've rallied back to this point. If the data disappoints, you could have that narrative flip on a dime yet again to, I don't know, hard landing or something else.
I thought what Neil said was perfect. Economists worry about levels. They talk about levels. Markets don't care about levels. Neil was talking about this. What matters is change. Are things getting worse or are they getting better? And I think it's a much, much harder task to tell people right now that things are getting better. So we're all waiting for Chairman Powell in a couple of weeks. Were you waiting for this? Fed Chair Donald Trump, in a news conference yesterday, I have a better instinct than in many cases people that would be on the Federal Reserve or the chairman.
He said it's really a gut feeling, and given his past business experience, he knows where interest rates should be. What I found shocking about this is we have been asking former Trump officials on the record, behind the scenes, what happened to that Wall Street Journal report in April, this 10-page document allegedly the Trump campaign was looking at potentially how Trump would try to erode the independence of the Fed. Well, he kind of just said it right there. If he is going to be president, he would want to exert more power on the Federal Reserve. The issue, of course, is that the Federal Reserve gets their mandate from Congress.
Well, if he was able to do it, I was just thinking how incredibly helpful this would be for his aim to have a weak dollar, right? This is how you get it done. Because presumably you put in tariffs, you have tax cuts. That means that the Fed needs to hike. Therefore, you have a stronger dollar. The way that you can ensure you have a weak dollar is if you have control over Federal Reserve policy and can cut into that strength.
This is certainly a good way of getting people to run away from U.S. assets, which would certainly hit the U.S. dollar. I'm with Anne-Marie. The first thing I did was pull up the Wall Street Journal article from August, which read as follows: Trump allies draw up plans to blunt the Fed's independence. And what do we hear from Trump allies over the last few months? They poured freezing cold water over that report, backed away from it, pushed away from it, questioned the sourcing in the piece, and then we hear it basically from the former president yesterday.
And in the economics realm, what we heard from the White House yesterday, Jared Bernstein coming out and re-releasing the report that the White House did after that Wall Street Journal report, basically talking about how it is so important to the fundamental economics of the United States that there is an independent Fed. So now this once again comes back up to as an election issue.
This has been breathless all week, so deep breath. Let's go through the markets together. Equity futures on the S&P 500 up by about 0.2%. In the bond market, we've had a massive turnaround in treasuries through the week so far. Yields this morning a little bit lower. We're down 3 basis points. Your 10-year 395.51. Coming up this hour on the programme, we'll catch up with Steve Major of HSBC on the bullish case for US treasuries. Jeannette Lowe of Strategas as Trump and Harris agreed to debate. And Drew Matus of Metlife following the S&P 500's best day since November 22. We begin with our top story. Treasury yields dropping after a week of wild swings. Stephen Major of HSBC remaining bullish on bonds, writing, ever so quickly the higher for longer narrative has collapsed. Explanations range from the technical to the fundamental, even the political. But whatever, the bond market has moved to preempt the Fed. Steve joins us now for more. Steve, it's been too long, sir. It's good to catch up with you. I'm going through your year-end price targets. Let me begin with them. 350 year-end, 3% by the end of 2025. Steve, let's go through that. What is the big bullish case for you and the team for Treasury bonds?
Well, these forecasts were set some months ago, Jonathan. They haven't changed. I think the first wave of bullishness in the bond market that we've just seen And by the way, the bond market hasn't given up that much of its gains over the last week. It's pretty impressive how it's just performed. But I think the first wave is taking out the bearish view. So only 1 month ago, we were talking about reflation trades and various scenarios around the election. And the consensus positioning was for a bearish steepening. And that was based on opinion polls and probabilities, scenarios, etc. And I look at it now and I wonder, where's all that gone? A couple of months ago, people were talking about the case for keeping rates higher for longer. I think that was a very flaky, fragile kind of forward guidance. Again, that's gone. So the next move in rates is unambiguously down. The question is how much. If we get anything near 50 at the next meeting, and market is priced for between 25 and 50, then the market will set a price target of a lower yield. So, it could be that we get as much as the market is pricing in by year end. We could get more. The thing is, the market tends to lead the Fed, and I think you're seeing validation of that now.
Certainly what's happening at the moment, Steve. I just wonder how you think about the destination, the path, this conversation about 25 versus 50 in September. We've discussed that all week. Where are you on the destination? What's the end point for this cutting cycle once it starts?
Well, the muscle memory of bond traders and investors is 300 to 400 lower than the policy rate. So that takes you down to at least a 2 handle. I don't think the equilibrium rate and the R* has actually changed since before the pandemic. We've done work on that. Others seem to think it's higher. If you think the R* is higher and you try and add term premium on, you end up double counting. That's another point in the report there, that I think that the positioning is double counting term premium. So for me, 10-year treasuries should yield between 3 and 4. Having a forecast of 3.5 seems logical. I cannot explain why other people do what they do, but my suggestion is there's some double counting going on.
Stephen, I wonder when you think about the speed and the depth of your rate cuts and how that informs your view for where the level should be on treasuries. What is your North Star? Because this is a market right now trading that every single piece of data is a North Star.
Well, the thing is it? Because that might be part of the problem, in that we are being whipped around on every single cyclical data release and not putting sufficient weight on the longer run secular trend. And by the way, Anne-Marie, if you look back at previous cycles, you'll see that it was impossible to call the turn based on the payrolls data or the CPI or the ISM, and that makes me wonder why people spend so much time talking about it. I mean, you can only use the unemployment data with hindsight. So it strikes me that everyone is trying to pass every bit of information they can to try and get an edge, a forward-looking edge. But the truth is, yields have been falling since October of last year. The front end of the curve failed 3 times to break above 5%. Look, we're actually entering a bull market for bonds here. We had a good year last year. We're having a good year this year. Bonds are not supposed to be generating double-figure returns. They're supposed to be the boring person at the party. A bit like me, really. The fun comes from all the other assets that you talk about. So if bonds can generate 5, 6, 7% a year, that should be just enough. And what they're doing right now is offering the perfect ballast in the portfolio, in a 60-40 portfolio or whatever. All that's come back, by the way. No one's talking about that.
Stephen, first of all, you're welcome at our parties anytime. I can assure you that. Are you telling me, though, you're looking at a trend here? Are you basically telling me that payrolls and CPI don't really matter?
Yeah, well, when you go down this route, you sound like a heretic. And I meet a lot of people who do give me a few funny looks sometimes. But I'm just saying, can we not put things in perspective and context? Because the cyclical data matters, but so does the longer run structural and secular story. And it's the more secular outlook that gives you your anchor. Your anchor is your longer run equilibrium rate. If you think it's 2.5, then the Fed's got a long way to go just to get to equilibrium. The terminal rate could even be below that. Other people think that the R*, the equilibrium rate, is higher. I don't know where they get their information from, but they're basically just describing the forward rate. And in markets, you need to have a view that hopefully is better than the forward rate. Our view is that yields will be lower than what the forwards are saying. It seems to me that others think differently, but again, I can't talk for what other people are forecasting.
Stephen, earlier to Jonathan, you mentioned that the market was tracking some of the polling. I want to talk about politics and a Trump victory. Now the polling is much tighter. Yeah. So is the market pricing in a Kamala Harris victory?
Well, look, it's a great question because only 3 or 4 weeks ago, you can see what the polls were. It was 65% in favor of the Republicans, and now it looks more like 50-50. I'm sure you've got more precise numbers, but you know what I mean. And so if you take the probability of a sweep for the Republicans down, then you presumably move the market pricing away from reflation trades, whatever they are. My guess is a reflation trade means curve steepening for bonds. It may be good for equities as well. It may be a good thing for equities. But if you move to 50-50, then that's quite a big change, isn't it? And I think that was the butterfly wing that started to flap before all the other stuff that came in terms of BOJ, Fed, ISM payrolls, leverage trades, unwinds, all of this stuff. It's a confluence of events in these last few weeks. But if you want to look back at what started the change, I think you hit the nail on the head there. It may have been those few weeks ago when the probabilities started to shift away from the reflation trade.
Steve, can we do a bit of scenario analysis? What would happen if it shifted back? Yeah. What would happen if Donald Trump won in November and he was much more assertive about pushing forward with the tax cuts that they had introduced back in 2017, 2018 and rolled them forward? What if we saw something aggressive on immigration? What if, like he suggested yesterday afternoon, he would be more assertive about Federal Reserve monetary policy as well? Would that challenge the secular story that you've described that's ultimately this massive tailwind for fixed income?
It wouldn't challenge the secular story. It might give us a bit of a cyclical bump. Now, in the previous month's asset allocation that we published, it couldn't be a more different context to today. And actually, a month ago, I wrote about this reflation trade and the probabilities and the scenarios. If you want to think what the world would look like in a sweep scenario for the Republicans, then I think you'd have to agree that the curve would be a bit steeper. Many of the policies might add to near-term inflation, and there'll be all kinds of risk premia that we'd have to think about around all the policies. So it's the uncertainty that would add to the steepening pressure in a bearish fashion. But as we just discussed, that probability has fallen, and that means that the weightings are shifting towards soft landing and/or hard landing, if it was as simple as that. And I think that kind of backdrop favours lower yields in the near term. In answer to your question about the secular story, we're talking 5 years ahead, 5 or 10 years ahead. Yeah. I don't think even that would be disrupted too much.
Steve, this was great. I've known you a long time. Been for beers with you. I can say on the record, you're not boring, Steve. We know that. Steve Major of HSBC. Steve, thank you, buddy. It's good to catch up, as always. The 10-year yield down by about 3 basis points this morning, 396. Danny, Steve's looking for 350 year-end, 3% by year-end next year.
So one of the, I guess, devil's advocates calls against that would be someone like Goldman Sachs, who says that we expect more growth. We still expect a strong economy, and therefore yields should be at 4.25%. But I think the fascinating thing about Steve's call is that it's not necessarily about each individual data point that comes in. I mean, he went so far as to say we're kind of missing the forest for the trees, just concentrating on payrolls and CPI, that we have a neutral rate. And in order for the Fed to get there, there needs to be a lot of cuts. So the direction of bias is yields down.
I have to say, based on what I've heard from the Federal Reserve so far, do you hear that from Fed officials, that they're willing, ready, even remotely prepared to validate what's being priced into this market right now?
Not at all. It is night and day hearing commentators on Wall Street and hearing the Fed. They keep saying this refrain, we have more time. Things are strong. We have more time to figure this out, to let inflation play out. That is not a Fed that is saying we're behind the curve and need to cut 50 basis points.
The Fed presidents daily, Barkin, Goldsby, Schmidt, all in the last few days, nowhere near where this market is at right now. Maybe that changes. Maybe they're waiting for Chairman Powell and Jackson Hole to be the North Star for them and change all of this. But right now, they're not validating market pricing at all. Equity futures right now on the S&P 500 positive by about 0.1%, just about holding on to gains, with some stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Microsoft said a group of hackers linked to the Iranian government tried to breach email accounts of presidential campaign staffers as part of a wider effort to gain intelligence ahead of the U.S. election. The company revealing attackers linked to the Islamic Revolutionary Guard Corps used a compromised email address from a former political advisor in a phishing attempt on a high-ranking campaign official. It follows a warning from U.S. intelligence officials last month that Russia, China, and Iran were recruiting people in the U.S. to spread propaganda. Iran has denied that allegation. China's consumer prices rose more than expected in July, climbing 0.5% from a year earlier. Bloomberg survey expected a rise of 0.3%. The jump was largely due to seasonal factors such as weather, leaving intact concerns over weak domestic demand and boosting the case for more policy support. Meanwhile, core CPI rose 0.4%, the least since January, indicating lingering weakness in overall demand. And TSMC reporting revenue jumped 45% in July, accelerating its growth from the June quarter and bolstering hopes for sustained demand for AI chips. Taiwan Semiconductor is seen as a bellwether for AI demand, as it's the go-to chip maker for some of the biggest AI companies like NVIDIA. For the third quarter, analysts expect TSMC's revenue to grow 37%, but the July numbers suggest the company may surpass those estimates. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it.
So no more debates about the debate. We've got an agreement? Good. That conversation up next from New York City this morning. Good morning. Live from New York, we're almost there. The weekend just around the corner. Equity futures on the S&P just about positive by 0.1%. Yields lower by 2 or 3 basis points. The 10-year 395.89. 20 minutes into the program, haven't even mentioned dollar yen. It's a good morning. Dollar yen 147.20 and just about unchanged. And there's your why. That's why we're not talking about it. And that's a good thing for many of you, I'm sure. Under surveillance this morning, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them. September 4th, September 10th, September 25th. And I think they'll be very revealing.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
So here's the latest. ABC News confirming Vice President Kamala Harris and former President Donald Trump have agreed to a presidential debate on September 10th. The two sides hitting the campaign trail in full force today. Harris holding a rally in Phoenix as Trump heads to Montana. Jeannette Lowe, Strategas, joins us now for more. Jeannette, this has been agreed. September 10th is the date on ABC. I just wonder from your perspective who is most at risk going into that.
I think that Trump is a little bit more worried about his positioning since Harris has gotten into the race and is now the Democratic nominee. So I think he is actually looking at this to try to have a similar debate as he had on June 27th against President Biden. So I think there's more risk there. What we're definitely seeing since Harris has gotten into the race is a lot more momentum on the Democratic side. You've seen the national polls, a 3.5 percentage point move from Trump, who had been up about 3 percentage points, to now Harris being up just as about 0.5 percentage point. In the swing states that matter for this election, you've seen a move of more than 2.5 points in Harris's direction. So now we really do have a 50-50 race where it could be very close come November. And I think he really wants to use the debate to try to re-highlight and be able to attack Harris on some of the key issues that he thinks are lacking now.
Jeannette, he also, yesterday in his press conference, Donald Trump floated 2 other debates. Who is more at risk of having more debate time when it comes to not just on this ABC News one, but Trump was floating an NBC News debate as well as a Fox News debate?
It's interesting. So obviously, I think the June 27th debate was probably a bit of a surprise to many people. Usually the incumbent president does lose their presidential debate, but that was just quite a different debate than I think anyone was expecting. Trump could be more disciplined in the debates, as we saw in the June 27th debate, but at the same time, there could be, different reactions, kind of like what we had in his press conference yesterday, where that could actually hurt him. Now, if Harris is also on the defensive and he's actually able to get a lot of blows, that can hurt her. So debates can actually be quite up in the air. I think that's why we also kind of want to see what happens at this first debate, and if that means we want more than one. Usually, obviously, we do have three, so I think Trump is now trying to go back to that traditional mode, but that's also a lot in a couple of weeks right before the election, so we'll see what happens.
We also heard from Kamala Harris yesterday, the vice president, talking about the fact that her team has scheduled, or she's asking her team to schedule, a sit-down interview before the end of the month. Unclear if that means it's going to be scheduled for August or potentially September. But there was also reporting that they would maybe want to sit her down with her VP pick, Governor Walz. Do you get a sense that the campaign is trying to shield her from some of these more direct confrontations with journalists?
I think it's unclear. I think one of the things that this has been a very fast campaign, so it's only been 3 weeks. I think to some extent she might be still trying to get her feet under her and make sure that she kind of knows what her policy positions are. So there could be some of that in part of the delay as to really being doing more of these interviews. But I think also she's kind of has the momentum at this point. Now, she is a better debater. She is better in front of the camera, I think, than she has been in the past. So I think that does have a benefit for her. But there could be other factors that I'm not quite sure exactly what they may be. But I think this is something that the Trump campaign is now trying to latch onto to try to make that saying that she won't show up in front of the press, she won't do interviews, and she won't take questions.
Jeannette, she's been vice president for about 4 years now. Is it a problem she doesn't yet know her policies?
Well, I think it's also just, as a vice president, she's trying to toe the line of what the President Biden wanted. Right now, we've seen that she is not taking necessarily the same positions that she took as a candidate in the 2020 cycle. So things like fracking, she's trying to moderate her position on Israel a little bit. I think these are the things that she wants to really make sure she has really ironed out better, because obviously we know in this news cycle that people love to take anything that you say and then kind of spin it. So I think she also wants to make sure she does have her messaging down, but she does also have a risk there that if she's actually not showing up in front of the press and she's not able to answer questions and talk about her policies, that can also be a risk for her campaign as well.
Jeannette, just before you go, quite clearly the vice president is driving enthusiasm at the top of the ticket. How are Senate and House races evolving since Biden dropped out and she stepped up?
Yeah, so one of the biggest things that we've seen is that since Biden got off the ticket and Harris is now the new nominee, we've seen the odds of a Republican sweep drop quite a bit. They were at 55% on July 16th. They're now down to 32% this morning. And you also have 25% odds of a Democratic sweep and 25% odds of divided government in the scenario of a Democratic president, Democratic House, and a Republican Senate. I think what's interesting about this cycle is that you could have divided government under either scenario, whoever wins the presidency, just because the margins are so tight right now in the House and the Senate. So for instance, if Harris is getting a lot of momentum, the Democrats only need a net 4 seats to win the House. And those are seats that are also in states like Alabama, and there's 1 seat in Alabama. There's seats in California and New York and New Jersey. The Democrats do have an opportunity to flip this cycle. So if she has momentum, even if she doesn't win the presidency, there is still a possibility the Democrats could have control of the House. On the flip side, the Senate does look like it's going to move to the Republicans because you have Senator Manchin no longer running in West Virginia. I think that becomes a Republican pickup. And then also John Tester is currently down in the state of Montana. And so that could be another pickup. So there is this interesting dynamic where we could have divided government no matter what. So I think that that's something that we need to look forward to because it's obviously going to have big implications for what policies can be enacted next year, and particularly as we're talking about the debate, as about taxes and the debt ceiling debate.
Jeannette, got it. Just fantastic as always. Jeannette Lowe there of Strategas. Scene. The vice president hasn't answered any questions. So she approaches you and says, what questions have you got? And you respond by saying, when are you going to answer questions? What were they doing yesterday?
You could have also just said, here is a question for you.
Start asking some questions about policy. Honestly, from New York, this is Bloomberg. We are on course for a fourth week of losses on the S&P 500, potentially, and we could have raised them a little bit later on, but potentially the longest weekly losing streak of the year so far. Equity futures right now on the S&P positive by 0.2%, on the Nasdaq 100 up by 1/3%, on the Russell up by 0.4%, and I think we've firmly established, Danny, that good news is good news and bad news is bad news based on the incoming information and how this market's responded to it.
Well, to be clear, the good news was jobless claims that surprised to the downside in a good way by 7,000 people. We had the biggest rally since 2022 because 7,000 people in the entirety of the United States did not file for jobless claims. I think that says a lot about where this market is, that we're just grasping at things, trying to get a handle, and the market will chop both up and down until we do.
We've had some great guests this week. I think one of the best, Jim Karen, Morgan Stanley. Jim said the last few weeks you've learned more about the positioning than you have about the fundamentals. And to your point, jobless claims, great example of that.
Yeah, certainly. And I mean, you even look at what's going on with the yen. We all look at the yen today and we say, oh, great, it's being calm. Well, of course it is. Nothing is going on with the BOJ today. I think everyone is just looking at every move in the market with bated breath, that they feel like because you had this big volatility upset on Monday, that more could be on store. You have other people celebrating the fact that the volatility has calmed down, and maybe that's a fool's errand.
Just waiting for the next data point to get whipsawed all over again. Switch at the board and turn a page, and let's go to the bond market. And I've mentioned this a million times this week, but still, I think it's stunning, and we should talk about it again. The 2-year at the start of the week, the low on Monday was 365, just south of that. On a 2-year, we're just north of 4%, 4.03%. It's kind of remarkable to see where the 2-year was Monday morning, how the world felt, and where we are at the end of the week.
This is why when people say, look, bonds did their job. They protected you on a Monday when stocks were selling off. That basically papers over the fact that yields are indeed higher on the week, that you have a market that had this big convulsion, and bonds convulsed too. You had so much volatility in an asset class that's supposed to be the staid part of your portfolio. This is supposed to be the boring part that doesn't move a lot, and it didn't give you that this week, even if it did give you some protection.
How many bond people have been on this program in the last week who have looked actually quite excited? Quite excited that like their world was where the fireworks were for once.
Right.
Big time.
The revenge of the bond nerds. And it's this kind of, this idea of, look, bonds have been pricing in something worse for this economy for a while now. You equity guys have been living on a hope and a prayer that everything's going to be wonderful, and now you're coming around to our camp.
The Steve Majors of this world over at HSBC feeling very validated by the last few weeks. I want to turn to dollar yen. Danny mentioned it. Dollar yen's just about unchanged, so nothing's happening here whatsoever. 147.18. I think you've got to put two things together this week. The data calmed things down a little bit. Wasn't just jobless claims, it was ISM services as well. And the BOJ backing away from things just a little bit too. I think just took some pressure away from this story for now. Whether it comes back, I don't know. The fact of the matter is dollar yen is about to post a week of gains for the first time since June. That's how vicious things have been the other way in dollar yen.
Well, I think the worry for this market has to be is we've seen ties in different parts of this market that we didn't necessarily think were there. For example, big tech sells off at the same time you have yen appreciating. Are they now so interconnected that, we get NVIDIA earnings at the end of the month? If they're really bad, do you see a yen appreciate? I mean, that would be kind of crazy under any circumstance, but I think we need to ask those questions after a day like Monday.
It's a bonkers world, not just Monday, but over the last few weeks, that's for sure. Under surveillance this morning, if you are just joining us, just an update on where we are with the Fed speak. Kansas City Fed President Jeffrey Schmidt signaling he's not ready to support an interest rate cut, saying we're not quite there in calling inflation, and the labour market still appears healthy. This word healthy is something that's come up a few times. We've heard from Barkin, we've heard from Daly, we've heard from Gorsby, we've heard from him. And I have to say, they all seem to be on a similar page. Are we ready to cut interest rates? We're getting close. Looks like it's going to happen in September. Are we ready to validate market pricing? I mean, my word's not theirs. I'm just going to infer, based on what they've told us, they're nowhere near ready to validate market pricing.
It's not even the pricing, it's the conversation. Just to add more Fed speak to the mix, Fed President Susan Collins sat down with a paper in Boston, and she said that we are going to have rate cuts soon, so perhaps the most dovish speak of all of them. But her justification is that if CPI keeps falling, the Fed is still talking about inflation. The Fed is still talking about getting back down to 2% as the most important part of the dual mandate. The market's moved on from this, and you can see it in the reaction to the data. We care more about unemployment than we do CPI. But the Fed, again, in their conversations, still talking about inflation as the guiding star.
After I heard from Mr. Rosenberg yesterday, basically saying we might be in a recession. And he's saying that what everyone's discounting is the fact that look at what's happening with hiring, not firing. I was struck by what Thomas Barkin said yesterday. He says there's no hiring, there's no firing. That's what we're seeing in the data. And he says that's what he's hearing on the ground in his district, in his state. That's what business leaders are saying. So he pretty much sees this normalization, but basically saying it could go either way.
Danny's absolutely right. There's a dual mandate here: full employment, price stability. The market's gone from focusing on price stability to exclusively on the labour market side of the mandate, and the Fed's sort of balanced between the two right now. That's what it feels like. That's what it felt like with Chairman Powell in the news conference in the last few weeks. That's what it looks like based on what we've heard from Fed officials.
And the risk with that many people will say is you can say, look, we're not worried about these labor markets because sure, hiring is not great, but no one's getting fired. The risk is always that once layoffs start is that you're too late. You know, it's kind of like the beach ball being held underneath the water, that when you let go, it just shoots higher. So by the time layoffs happen, if that's when Fed officials wake up to that reality, the argument goes that they are far too late.
This self-reinforcing process has started. That's the view of the bears right now. Danny mentioned inflation in America. I need to talk about CPI out of China, coming in higher than expected for the month of July. Seasonal factors like weather driving the rise, leaving intact concern over sluggish domestic demand and boosting the case for more support. It's interesting to hear from a couple of economists on the street, in fact, not just in the United States, but worldwide, the reluctance of Chinese officials to really loosen up fiscal. And they were reluctant to do so until maybe 2025, once they've worked out what it looks like politically here in the United States. And that's quite a take at the moment. I think that's consensus for many people watching that economy.
Well, because the state council came out with a plan to boost domestic demand. They were going to have to inject some fiscal stimulus into the economy. But Goldman Sachs said, hold on, we think China's actually holding back on the firepower because they might need that ammunition if there's going to be a Trump presidency and he puts up the walls, including 60% tariffs on all imports coming from China.
Not just if it's Trump or Harris. We still need to work out what Harris's position actually is. What is the vice president's position on China, tariffs and policy for trade worldwide?
We don't know. That's the point I think you made earlier, Jonathan, the fact that she goes over and talks to reporters and what they want to ask is, when are you going to sit down for us to ask these policy questions?
Blows my mind.
I imagine, though, she has been the vice president for under Biden, and it will be a similar trajectory. So they're going to keep some of those tariffs, but no one's talking about in the Harris camp about putting up a tariff ring, a wall around the United States.
I think we're all hoping for a quiet end to the week. Looking ahead to next week, though, things get very busy. PPI, CPI, retail sales, all next week, and we're all looking for evidence of a soft landing. Drew Matus of Metlife writing the following: while risks of a more significant downturn have risen, given that the equity market volatility may have prompted some additional concern from higher income workers, we continue to expect only a moderation in growth. Drew joins us now for more. Drew, great to catch up, sir, as always. Let's get straight into it. Why are you only expecting a moderation in growth? Where does that more constructive view, Drew, come from?
Well, I wouldn't call it more constructive. What I'd say is that...
I'd certainly say it's more constructive relative to what we've been pricing into this market over the last week, Drew, wouldn't you?
Well, one of your guests yesterday basically said, I was here and the market went here and then it's coming back and he's been unchanged, right? And that's where we are is, there's going to be this moderation growth. What I think people are really missing with regard to the labor market story is hours are continuing to fall, right? There's a limit beyond which when hours fall, you'll start firing people, right? Because you're paying people to do nothing. And we're seeing a lot of paying people to do nothing in the data. And it's only really a matter of time before companies have to kind of justify paying those people to do nothing. And so, calling the labor market healthy, is the housing market healthy because no one's transacting in it? I don't think so. It doesn't look healthy to me. So why would the labor market be healthy if no one's transacting in it?
So, Drew, build on that for me. When you look at Fed policy at the moment, how wide is the gap between where you think the Fed is and where it will be and where you think it should be?
I mean, they should have been cutting months ago, as people like Neil Dutta have been suggesting. And, the fact that they waited now doesn't mean they can play catch up. They tried this before with rate hikes, right? They missed the bus. And instead of trying to just kind of gradually move policy where they needed it to go, they decided to run after the bus on their skateboard and they got hit and taken under the tires, right? So they don't want to do that again. At the same point, the weakness tends to actually gain momentum. And so I think, what we've seen with claims, for example, people are excited the claims went down last week. The average, if you just kind of get rid of all the volatility week to week in claims, is still towards weakening labor markets. It's still towards more people filing unemployment insurance claims, particularly when you look at it as a percentage of the population that's allowed to file for claims, right? So not every worker can file for them. And when you look at it that way, it's pretty much a straight line higher. And that's something that should worry everyone, including the Fed, which should be thinking to themselves, what's the peak in unemployment that we want to accept And when do we have to cut rates to get there? And I think they've already missed the boat if they were hoping for 4.5 to be the peak in unemployment. The question is, do they want the peak to be above 5 or below 5 at this point?
Drew, can you square something for me then? Because you sound quite concerned. The trend is getting weaker, as you described. But am I right in that you only expect 75 basis points of cuts this year? You sound like you would want to be more dovish than just 75 basis points of cuts, given everything you just said.
Well, a month ago, I was perceived to be more dovish, and people were, internally and externally were like, really, you believe 75 basis points of cuts this year? And so, rather than me adjusting myself, I think everyone else's view on what it takes to actually get to a better place has kind of gone off the deep end a little bit. And you've seen that reaction in the bond market. You've seen it with Fed funds expectations, where people are expecting 125 to 150 basis points of cuts by the end of January, which is the first meeting that the Fed has in 2025. And you see it in the 10-year, right, where, below 4% is not where the 10-year should be, given the state of the economy, the state of inflation, the state of the budget deficit. And what you can expect maybe for productivity going forward once people begin to actually harvest the gains of artificial intelligence.
So Drew, in a world where the market is right, what does the economy need to look like in order to get 100+ cuts this year?
I think you need the unemployment rate fast approaching 5, so the pace of the deterioration, the unemployment rate doesn't slow down. And I think you need to see inflation come down maybe more than it will. We're not worried about inflation, and we don't think the Fed should be worried about inflation. If the unemployment rate's going up, you can count on the inflation rate going down. And I think that's the trade they're going to make as they approach the end of the year. But we still think that they're going to be cautious there, right? The pace of the slowdown is still a relatively moderate pace of slowing, even though we are expecting unemployment will continue to move higher.
Drew, so you think the Fed should have already been cutting months ago. Yesterday, David Rosenberg said to us the Fed is, quote, ridiculously behind the curve. He also mentioned something in the data that you're talking about, which is the fact that hourly work from individuals is starting to fall off a cliff. But he thinks potentially we're in a recession. Do you share that view?
I don't think we're there quite yet, but I'm not sure if it's a coincidence that David, Neil, and I all worked together back in the day. We tend to look at the world for what it is, and what it is right now for an employee. Are you going to go to your boss and ask for more money next year?
Yes.
Despite that inflation. When no one's getting hired if they get fired, right? No one's going to put their hand up there. And that's the part of the equation that people are missing. Oh, well, no one's being fired. It still affects the dynamics of the labor market and still will affect the dynamics of consumption.
Drew, everybody should do that. Go away. Drew Matus of Metlife. Thank you, sir. It's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The U.S., Qatar, and Egypt are calling for a new round of ceasefire talks, the latest effort from the Biden administration to end the war in Gaza. Israel said it will send a delegation to the talks scheduled for next week, while Hamas did not respond. U.S. officials now say a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. Paramount Global saying it will cut about 15% of its workforce, amounting to about 2,000 jobs, as it prepares for its merger with Skydance Media. The parent company of Nickelodeon and MTV reporting earnings that beat Wall Street estimates after its streaming division, like Disney, swung to its first ever quarterly profit. But like Warner Brothers Discovery, Paramount took a second quarter impairment charge of $5.98 billion on its cable networks, marking another sign of weakness in traditional TV. And former President Donald Trump saying presidents should have more say over interest rates and monetary policy. The move would go against the long-standing tradition that the Federal Reserve is independent of political actors. Trump telling the media from Mar-a-Lago that the Fed has been a little too early and a little bit too late in moving rates, and that he may have better instincts than those at the Fed. Powell has pledged not to let politics influence his or the FOMC's decisions. That's your Bloomberg Brief. John?
Yahara, thank you. I want to pick up on that story. Based on those comments, do we go back to that Wall Street Journal story of April this year? The headline read, Trump allies draw up plans to blunt the Fed's independence. Is this about blunting the Fed's independence through some kind of formal channel, setting policy to do so? Or is the former president saying that if he comes back into the office, he'll be as loud as he was before? about offering an opinion about where Fed policy should be. Which one is it?
It's hard to understand, but these are the most direct comments we've seen him talk about Fed independence. The word he used yesterday was gut. He said, the Fed kind of gets it wrong. They're tending to be a little late on things. Maybe he gets a little bit too early. There's very large a gut feeling, and I believe, I have that gut feeling.
We'll try and get some more opinions on this for you throughout this morning. Up next on the programme, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. I am definitely not one of those people that would say to you, it's different this time.
That conversation up next, live from New York. You're watching Bloomberg TV. I don't want to jinx this, but this is what a calm summer's morning is meant to look like. Equity futures not doing much, up 0.1%, no data, not much Fed speak, very light on earnings. In the bond market, yields a little bit lower, down 3 basis points, 395 earlier this week. People freaking out about dollar yen. Dollar yen is almost totally unchanged on the session. This is how you want it going into the weekend. Let's hope it stays this way. Dollar yen 147.14. Under surveillance this morning, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. What's tried, tested, and true is the unemployment rate. And the unemployment rate is up 0.9 of a percentage point over the past 15 months. When you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. I am definitely not one of those people that would say to you, it's different this time.
Is it different this time? Here's the latest, a full slate of economic data ahead next week, headlined by Wednesday's CPI report and a double dose on Thursday with retail sales and another round of jobless claims. Paul Donovan of UBS taking a balanced view on the economy, writing the following. Equity markets have been meandering rather than moving with clear direction. The unwinding of more speculative trades should have concluded, allowing economic fundamentals to gradually reassert themselves. Paul is with us now for more. Paul, I'm happy to talk about fundamentals with you, so let's go there. Walk us through how much stress, Paul, there is in the US consumer and whether you can identify whether it's starting to migrate from low-income households to middle-income households and maybe even further.
Well, it is the middle-income household that is critical because that's the consumer that really is behind the growth. Now, the bottom 30% of income distribution, of course, they matter socially, they matter politically, but they don't have the spending firepower that the middle-income consumer has. And to be honest, if you are a middle-income consumer, as a household, life's pretty good. Very low fear of unemployment. You've got a job, you're not losing a job. You're seeing increased female participation. And what's critical here is women are taking jobs paying above average earnings. They're moving up the quality because flexible working is giving childcare providers a lot more ability to take high quality jobs. That's enhancing household spending power. You're in a low inflation environment. If you're a middle income household, remember the nonsense of CPI despite Powell's absurd obsession with it. CPI overstates the cost of living for middle income households. All of this is really beneficial. And I think it means that the middle income consumer is going to continue to put in a pretty solid performance.
Well, I love the phrase that you've said for a while now, not to short the hedonism of the American consumer. And so far that has played out correctly. I just wonder, in your view, what does it take for that to deteriorate?
So the thing which would really cause me concern, the one thing which is going to stop you guys going to the shopping mall or, spending money you don't have on things you don't need, the one thing that would cause that to come to an end, I think, is a significant fear of unemployment. But fear of unemployment is not driven by temporary job layoffs, which is all of what happened last week, pretty much. Fear of unemployment is when either you are seriously concerned that your permanent job will be taken away from you, or friends and family are experiencing that. And we're just not getting that at this stage. But fear of unemployment is what we've got to look at, and that is job losses for permanent workers and more widespread, not sort of geographically or sector concentrated.
I know Monday was only a blip, and you're talking about seeing friends and family lose their job and fear of that. But if the market were to have more days like Monday, where you just have, I don't know, it could be a data print that is not really representative of the overall economy, but you have more things like that, is that enough to have that feedback loop that you're talking about? Can the market do that job?
No, I don't think so. So here's the thing, which we sort of whisper about in my profession. Financial markets aren't as important as they think they are. In the real economy, it's not the large listed companies that dominate employment. It's the mom and pops, the Mittelstand in Europe. It's the small, medium-sized businesses that dominate employment, that dominate things like job security and so forth. So the market going up and down, yes, there's a bit of a wealth effect. You've got to remember, most Americans don't own a lot of equity, and the equity they do own is indirectly held through 401ks and similar. So the fluctuations of the market don't sort of immediately lead to correcting behavior on the part of the consumer. Now, house prices, they're a lot more significant in terms of affecting consumers' perception of their wealth. But otherwise, the ups and downs of the market, the fairly wild swings that we were seeing earlier this week, very limited feedback loop at this stage.
I want to ask you about what's going on in China, because you talk about in your note this morning, we did have inflation tick up slightly, but this has to do with weather effects and food. The issue is demand. Do you think the Chinese economy needs a monetary policy approach to this, with the PBOC potentially cutting, or do they need to pump some fiscal stimulus into this economy?
Well, my view here is that it really needs more on the fiscal side. It's not really a credit-constrained economy. That's not what we're seeing. What we're seeing is an unwillingness to spend. Now, this may be fear of unemployment coming through. We've got to remember that particularly youth unemployment, even on the official numbers, is still quite high, and the expectation is that it's probably higher than the official numbers portray. There's also concerns about the need to rebuild savings post-pandemic, in the absence of a particularly robust welfare state. So in that situation, I think easing the cost of credit has a fairly limited impact. I'm not saying it's zero, but it's not going to be the main driver. Really, what you've got to try and do is boost consumer demand through consumer confidence, through giving people a greater sense of security about their economic futures.
Do you agree with some of your colleagues on the street, though, that potentially China is holding back and waiting till we get the results of the U.S. presidential election?
I'm not sure that that is necessarily the case. I mean, I think China is going to try and achieve its 5% growth target, because China always tries to achieve its growth target. And in that situation, I think we're getting this sort of drip of stimulus measures, a little bit here, a little bit there, easing in this provincial fiscal policy, bit of an easing on the credit condition side. And that's to try and maintain, on the official numbers again, around about a 5% growth rate. Now, the thing is, if President Trump does come in and wins re-election and puts in place a 60% tariff, and it's not just a sort of a bargaining tool, that would be very, very disruptive for the China economy. The universal tariff would probably also be very, very disruptive for the China economy, and that would then require additional measures. But that's such an extreme situation. US would probably end up in recession as well. So you've got a really compounded problem that would require separate measures. There's no point waiting and umming and ahhing about does Trump win or does Harris win. I think China is going to focus on its 5% domestic target for growth and achieve that, independent of what is going on in the exciting world of US politics.
Paul, it will remain exciting, I'm sure, for the next several months and maybe even a long time. Much, much longer than that. Paul, thank you, sir. Paul Donovan there of UBS. I want to just get to Paul's comments on the labour market and the US economy. That fear of high unemployment, in Paul's mind, hasn't gripped this market, this economy, just yet.
When he says the market thinks it's more important than it actually is.
Isn't that always the case?
Yeah, it always is. I also love his view of the American consumer. Like, you are spending money that you don't have. I feel like kind of directly
on things you don't need.
On things you don't need, and that's going to continue until you see your sister, brother, parents lose their job.
It's funny, that felt personal to me too. I think it felt personal to a lot of you. Coming up in the next hour, Bloomberg Surveillance, Anastasia Amoroso of iCapital, Congressman French Hill of Arkansas, Debra Netschert of Jennison Associates, and Meghan Swiber of Bank of America. With futures just about positive by 0.1%, you're watching Bloomberg TV.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is.
There's a higher risk of recession than zero, but it's still not a base case for us yet.
I still think that we're either in a recession or about to confront one.
I don't think that we're at the point yet where things are tipping over the edge where the Fed's going to have to start cutting 50 basis points.
There are pockets of weakness, but overall, the U.S. economy remains in solid shape, and that's the story I like to tell.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I bring you better news. Things are quiet, snoozy even. Start going to the beach already? I don't know, but things are better. Equity futures on the S&P 500 going virtually nowhere. On the S&P, we're positive by about 0.2%. On the Nasdaq, up by 1/3%. Let's see if it sticks. But just to take the temperature of where things are this morning, nobody's talking about dollar yen. Dollar yen is basically unchanged on the session at 147, and we can put our hands together and hope it remains that way. 147.13 on dollar yen. Things get busier next week, so let's get to the calendar. CPI, PPI, retail sales. Jackson Hole a week later. Danny, the stage is set for a very interesting speech from Chairman Powell.
And it's interesting to think about what they'll care more about in between those individual data points. You have to assume for this market it is retail sales, because if we are worried about a downturn in the economy, if we are worried about the consumer, considering what we've heard from earnings, retail sales will be the most important for us. But the noise from the Fed is still inflation.
This week's very different to last week. Last week we had bad data, ISM manufacturing, jobless claims, payrolls, the unemployment ticking higher once again. We had the BOJ hiking interest rates and suggesting the bar was pretty low to go again. This week, like the reverse of that. Data's a little bit better. Jobless claims a little bit lower. That's good. We saw ISM services. That was better as well. In expansion is where we want it to be. And the BOJ backs away. That's the ingredients for things to settle down just for now.
But let's be honest, that data was tier 2 data. I mean, it was jobless claims. It was ISM. Not to say that they aren't important. I don't mean to be flippant about people applying for jobless claims, but it is usually not your North Star of data. If you listen to Stephen Major, none of it should be your North Star, that you just need to think that the neutral rate is lower, and we're going to head there. Therefore, you should be buying bonds.
And when it comes to data, I'm looking at what Mohamed El-Erian continues to say. What are the CEOs saying on the earnings call? So Expedia comes out. They have posted better than expected results, but they say they're seeing this softening demand. And the CEO said in July, we saw this softening demand, concerns about the macro environment. So what they're saying about the future is that potentially less people are going to be getting on planes and booking hotels.
Airlines first out the gate. Delta, United, American, Ryanair on the other side of the Atlantic all said the same thing.
And I think it all shocked us because travel numbers are high. How many times did we sit here before a holiday weekend saying it's going to be records at the airport, it's going to be a mess, there are going to be so many people? So for the airlines to turn around and say, actually, we are struggling, I think was whiplash for a lot of people. It could be what Torsten Slot from Apollo was talking about. It's that business class, first class, they are still doing fine. So all airlines are reflecting is a bifurcated economy.
That consumer softness not exclusive, of course, to the airline business, the travel business. We're seeing that elsewhere as well. Just to check in on the scores for you, on the S&P 500, just about positive by 0.2%. A little bit of a lift in the equity market this week has included the biggest one-day loss since 2022 and the biggest one-day gain since 2022. Monday and Thursday, two very, very different sessions. In the bond market, yields lower by 3 basis points on a 10-year, 395.32. Coming up this hour, we'll catch up with Anastasia Amoroso of iCapital following the S&P 500's best day since 22. Congressman French Hill on whether the president should have an influence on Fed policy. And Meghan Swiber of Bank of America now expecting a greater degree of curve steepening. We begin with our top story. Stocks posting their best day of gains since 2022 following the right kind of downside surprise on jobless claims. Anastasia Amoroso of iCapital writing this. Markets may be getting sufficiently close to pricing in current recessionary odds, and pullbacks may be buying opportunities, especially if the recession is averted. Anastasia's with us around the table. Anastasia, good morning.
Good morning.
Let's talk about the evolution of your year so far. Coming into the year, I would say more bullish than most. Yeah. A little bit more conservative, I would say, through the back end of the summer, coming into July. Where are we now? How has your thinking evolved?
Yeah, I think that's right. I would say in May, we wrote this piece where we talked about the reasons for optimism and the reasons why you wanted to buy the April pullback that we had. Then coming into July, we wrote this piece and said, look, we've had a stellar first half of the year, but here are the risks for the second half. And it's not like we were calling for those risks to materialize, but if you think about election uncertainty, that was on the list. If you think about slow consumer, that was on the list. And also this potential disappointment from AI and all the hype that we've had there. So we've sort of checked a lot of those risk factors. So now, when I look at the markets, you talked about the dollar yen. The reason why the U.S. market does not seem to care is because for us, the biggest risk is the recession. And how do we price in a recession? And this is why that's something that I was thinking about. To what extent have the markets actually reflected the recessionary odds? Well, the Bloomberg consensus of economists forecasts about a 30% probability of a recession. There's a range of estimates. So one of the Fed's models is looking as high as 50. The JP Morgan model might be looking something like 43%. But when you size that relative to the market pullback before the bounce back yesterday reflected also a 30% probability. And so we're kind of at this, 200-day or 100-day moving average to fully reflect, I think, some of the worst forecasts for the recession. I would say we need to pull back another 5%. So when I look at that setup, John, I say we're sort of within the strike zone of, getting close to pricing in the recession based on what we know today. But especially if we avert a recession, buying within the strike zone between a 100-day and a 200-day moving average, that seems reasonable.
So the price of the story is where you're focused. There'll be a lot of people obsessed with asymmetries. They always are. When you think about how this market is more sensitive, is it more sensitive now to better data or worse data? How do you think the setup will sort of play going into next week, which is a big week for economic data?
Well, I think we have reset this quite a bit. If you would have asked me this probably a week or two ago, I would have said, definitely, we're more sensitive to worse data, because that was, by the way, one of the things we worried about in the beginning of July, this disconnect between the elevated earnings expectations and the economy that was clearly slowing. But now that the economic surprise index has been negative for months, and now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises. And by the way, we might see that, maybe not from retail sales necessarily next week. They're expected to be pretty sluggish. We might see that from the payrolls data going forward. I mean, there are a lot of opinions out there, but if you look at the numbers, the 4.3% unemployment rate, a lot of that has to do with new entrants into the labor force, the immigration that has occurred. But specifically in July, it's the pop in temporary layoffs. I do think that some of that may actually reverse, and there are estimates out there that look at what payroll creation might have been had it not been for Hurricane Beryl that hit Texas. So I think we are likely geared for that positive surprise in the coming months.
It's a blessing and a curse just listening to you talk of all of the data we have. We literally are swimming in it right now, not to mention that it's also earnings season.
Yeah.
And sure, the talk from the companies, some of it with the consumer has been a bit dour, as we've been discussing. Earnings growth is really strong. It's something like 10% for the quarter so far for the S&P 500. Globally, the best quarter in 8. How do you square all of that together?
Yeah, I think earnings growth, especially for non-Mag 7 companies, is actually surprising to the upside and is expected to pick up in the back half of the year. So I think that's, again, maybe the underappreciated story by the market. And look, I'm not in a recessionary camp. I'm in a soft landing camp. And I do actually think that some of the companies that are sensitive to interest rate cuts, like financials, like regional banks, like real estate, they may be benefiting from that as we progress through the year. So I would see some upside to the non-Mag 7 earnings picture.
So when you have a day like Monday where Mag 7 sells off, do you not touch it, or are those dips you'd want to buy?
I mean, most people are probably sufficiently overweight, or at least market weight the Mag 7. So I actually don't think that's the first place you look. What most people are underweight is either the defensive trade or the rotation trade. And I'm going to come back to semiconductors here in a minute. But I do think in an environment where the economy is slowing, we're not recessionary, but we are slowing. You want to step into sectors like utilities, for example. You want to buy bonds, specifically municipal bonds, if you're a higher income consumer. You want to buy the rotation trades like real estate and regional banks, because I think people started that rotation. It was sort of short-circuited, but I think it's the right place to be if the Fed is cutting rates. And that brings me back to semiconductors. People are probably sufficiently overweight semiconductors, but if you look at the pullback in valuations, we're not quite, but we're getting close to the lows that we've seen in the last year. And the earnings expectations for AI semis in particular are still going up. So I think that's a great setup.
You mentioned utilities. Is it back to being a bearish play or defensive play? Because at one point it was an AI trade.
No, it's definitely a defensive trade at this point. And I mean, let's not forget there's absolutely still the potential for AI upside, and the fact that we need to almost double our electricity generation capacity in order to service the data center and the AI opportunity. But no, it is back to being the defensive trade. It's the fact that it does have a yield that is higher than the market. It's the fact that it does have economic resiliency. And when we look at how utilities in particular have performed, they've held up better than most sectors going into the first rate cut and coming out of it in the 3 to 6 months period after that. So I think a lot of people are paying attention to that. And look, this is a two-way market now. I think there's risk to the upside and the downside. And that's why I think a lot of investors are looking at this barbell approach of defensives plus some risk.
John and Danny earlier in the program are talking about how good news feels like good news and bad news feels like bad news. But you said earlier, if we get a good employment report, would that mean bad news for this market? Potentially, some people will say maybe that irks the Fed a little bit.
No, I don't think so, because, that brings us to the second part of the mandate, which, of course, is inflation. And we're looking for the CPI number next week to come in at, 3.2% on the core CPI inflation. So as long as that inflation trend is intact, which is still, gradual progress towards 2%, if we get a somewhat stronger labor market, I don't think that negates it. Look, the Fed really realizes right now that the real interest rates are high. They're tight. And so with the economy that's generally speaking slowing, they do have a lot of room to cut interest rates. So why not start a little bit? Is it 50 basis points for several consecutive meetings? I don't think we can make that call right now. But I think the start of the rate cutting cycle, regardless of jobs, is here.
We're certainly getting closer, that's for sure. Anastasia, thank you. It's good to see you, as always. Thank you. Anastasia Amoroso of iCapital. Equity futures doing OK this morning. No real drama on the S&P 500, up by 0.2%. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Japan has issued its first ever mega quake alert after a 7.1 magnitude earthquake occurred off its southern coast. Several injuries have been reported in addition to limited damage to buildings. Right now, the country's bullet trains are running at reduced speeds, and some semiconductor factories have halted production. And Prime Minister Kishida called off a planned trip to Central Asia as a precaution following the warning. The government is not urging evacuations, but is advising citizens to be prepared that major earthquakes could continue. Several towns in western Russia have been evacuated after an attack by Ukrainian drones on a military airfield sparked a fire. State media reported that 9 people were injured and public transport was halted in one city, home to nearly 500,000 residents. It's part of what's become a nearly week-long advance into western Russia by the Ukrainian army, with troops reported 22 miles deep into Russian territory. And Donald Trump and Kamala Harris appear to settle on at least one presidential debate, with both candidates agreeing to meet on September 10th in a debate hosted by ABC. Trump said he had also agreed to debates on Fox News, and NBC. According to an anonymous campaign official Bloomberg spoke to, Harris will not agree to the Fox News debate and will only agree to future debates if Trump shows up to the ABC one. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Fed Chair Donald Trump.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Can you imagine? That conversation up next from New York City. This is Bloomberg. Live from New York City, welcome to the program. A calmer tape for you this morning. Equity futures up by just 0.2%. Euro dollar totally unchanged. Similar price action on dollar yen. If you're interested, we're going basically nowhere. 147 negative on that currency pair by about 0.1%. Bit of firmness, richness coming back into the bond market. Yields lower by 4 basis points. The 10-year about 394.74. Under surveillance this morning, Fed Chair Donald Trump.
The Federal Reserve is a very interesting thing, and it's sort of gotten it wrong a lot. He's tending to be a little bit late on things. I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
So here's the latest. Donald Trump using a Mar-a-Lago news conference to express frustration at the Federal Reserve. The comments echoing a Wall Street Journal report back in April, saying that Trump's allies are drawing up plans to blunt the Fed's independence should he win a second term. A report that Trump's team has since pushed back on repeatedly. Joining us now to discuss is Republican Congressman French Hill of Arkansas. Congressman, I'm going to start with a really dangerous question. What is the former president talking about?
Well, Jonathan, great to be with you. I think every president in the modern era has certainly criticized the Fed and lashed out at trying to have more control over the Fed. But since World War II, having Fed independence is important. We want to try to have price stability. That's their mission. I wish they focused only on price stability, but nonetheless, that's their mission. And over my time in public life, I've seen presidents tried to influence the Fed through moral suasion by calling them over to the Oval Office, like Jim Baker and Ronald Reagan with Alan Greenspan for the 1984 election year. But the bottom line is the Fed can have its chairman appointed by the president. The Senate confirms that position. The House and Senate conduct major oversight over the operation. The Fed. So there is political tension there.
Congressman, we heard from Jared Bernstein, of course, from the White House, director of the chair of the White House Council of Economic Advisors. He tweeted this yesterday saying history could not be clearer regarding the lasting and damaging inflationary consequences of ignoring this lesson of reversing the hard-earned progress of the past half-century. So you agree with the White House that the Fed should remain completely independent?
Well, I agree with the record of history that the Fed should be independent. That's a central bank tenet, that the Fed should generally, the central bank of a country should be independent of the fiscal authority or the legislative branch to protect price stability. And as I say, since World War II, when we had actually Treasury representation on the Fed board, that's been done informally through the appointment process to make sure the president's pleased with whoever the chair is. And the Senate confirmation process. And there have been times during tension where there's been White House meetings with Fed chairs or White House influence. Richard Nixon famously trying to influence Arthur Burns during the 1972 election cycle, the Jim Baker and Ronald Reagan anecdote that I just mentioned. But structurally, it's maintained its independence, and I think that's important.
So let's talk about some of the Fed policy. When the former president was talking about this yesterday, that he would potentially have a better gut feeling on what interest rates should be, he said that he, Chair Powell, tends to be a little bit late on things. He gets things a little bit too early and a little too late. And he says he would have this feeling that potentially he'd be a better Fed chair because of that. Do you agree with where the Fed is right now? Or do you think they should be cutting? And if so, do you think it'll be political for them to take this cut in September?
Well, Chairman Powell says they're data dependent. I think that's good. But I think the way to avoid these kinds of fights without much assurance of what direction or the other is to have a rules-based monetary policy. The so-called John Taylor rule from Stanford University. John and I worked together on the White House staff in the 90s. The so-called Taylor rule would make a range of mathematical recommendations on the targeting of short rates by the Fed, as opposed to it being just a group of individuals on the Board of Governors deciding that, or as Jim Grant refers to it, the PhD standard. We'd actually have a rules-based standard. Some others want to go back to a gold standard, but a rules-based standard would have a range of guidance to the Fed of when to cut and how much to cut. And that would take some of this instinct out of it.
So, Congressman, given that, and this is a criticism other people have said, that the Fed needs more of a framework. They don't have a reliable framework at this moment. Do you think that's something that should be mandated in for the Fed? Would you like to see something along those lines?
I would like to see a rules-based framework. And when Chairman Powell was before the committee a few weeks ago, I asked him the status of their reassessment of their very famous decision in August of 2020 in the middle of a pandemic to just let inflation run a little hotter than 2%, knowing that they could rein it in, which I think is a strong presumption that I don't know that's based in fact, as we've witnessed since 2021. So I think that is an opportunity for the Fed to reassess using a rules-based framework for their monetary policy.
Congressman, since we last spoke, this race has changed a lot, particularly in the last month. Can you talk to me about how you see things evolving right now? When it comes to the issues, I think the impression that a lot of people have that are coming on this program right now is that we're not really talking about those so much. It feels like we're talking about the enthusiasm, the vibes and the improvement that we're seeing on the Democratic ticket since the sitting president dropped out of the race. When it comes to the issues, I know that you're very, very focused still, Congressman, on immigration. Can you walk us through the things that you're concerned about? And do you think the former president is doing a decent job of prosecuting the case?
Well, first, let's start there. I think to win this election, it's a great opportunity for President Trump to be reelected. I think his policies are much more in alignment of my views are on the economy and national security, and particularly border security. But we've got to stay focused on the issues and get off some of the personalities here. Let's focus on the issues. And I think if President Trump and his vice president nominee, J.D. Vance, focus on the issues of national security, the border, community policing, inflation, they win, and they win hands down. On the border, what I'm the most concerned about by the horrible Biden policy of an open border is not just the millions of people he's allowed in the country that we don't have a full instinct of what to do about or how to handle it, and swamping our border patrol system, but the number of terrorists, people on the terror watch lists that are in this country. And we've asked Chairman Turner of the Intelligence Committee, Chairman Green of the Homeland Security, and I have persistently for months asked for this administration and the FBI and Homeland Security to tell us where these people encountered on the terror watch list are in this country. What has happened to them? And when you think about millions of gotaways, how many more people are in the country that we don't know about, that we did not encounter? I find this very concerning in light of the Pakistani comments about the Trump assassination attempt, the continuing documented Iranian influence in the country on assassinations, and the recent Philadelphia discovery of a ISIS-K network that was operating in the country, having come across our open border.
Congressman, if you're so concerned about the border, why did the Republicans then ditch this idea of the legislation that was circulating, starting in the Senate with Lankford, when it came to border security?
Well, first, we passed H.R. 2, which is the preferred approach for House Republicans on both immigration reform and border security. We got it passed. We sent it to the Senate. There was no action on it. Senator Lankford did good work trying to find consensus in the Senate. But look, he was still facilitating thousands of people, undocumented people, coming in the border. He was not taking the concrete steps that we put in H.R. 2. So I think, Anne-Marie, that was the key difference for Speaker Johnson, for House Republicans, and that's why that bill did not proceed in the Senate.
Congressman, we have to do this more often, sir. It's good to catch up. And
Great
I promise,
to be with you.
I say this every single year. Razorbacks football, we're going to make it happen this winter, OK? Going to make it happen.
You
All
got
right?
some...
Thank you, sir. Congressman French Hill of Arkansas on the latest in this race. The thoughts on the Federal Reserve there? I think we need to pick up on that. Could we see some real changes here?
Well, I think when you hear French Hill talking about this, he basically says, historically, we do know that the Fed has to remain independent. So basically, he agrees with the White House there, but he thinks the Fed should be more focused on inflation right now.
Yeah, and talking about this idea that there needs to be more of like a rules-based framework for them, I think a lot of people would agree. A lot of people have looked what Powell has done. You hear this criticism come up. He's not an economist. He's a lawyer. He doesn't have a clear direction in where he wants to go. I think it'd be interesting if they mandated something like that, because I think a lot of people like the flexibility of the Fed. So having a clear framework versus mandating, I mean, that is two very different conversations.
It's hard to predict things at the moment, but I will predict this. Chairman Powell won't address any of this in Jackson Hole in that press conference, or rather that address that we get from him in a couple of weeks' time. That's my prediction. That's the only prediction that I can offer at the moment, given how quickly things have changed. Equity markets right now in the S&P 500 shaping up as follows. We're just about positive by 0.1%. Up next on the programme, we'll dig deeper into the booming obesity drug market. We'll catch up with Debra Netschert of Jennison Associates on why the growth is only getting started. That conversation just around the corner. From New York, this is Bloomberg. 2 hours away from the opening bell, your scores look like this. The S&P totally unchanged. After some major volatility over the last few days, we're going nowhere. On the Nasdaq 100, we're positive by 0.04%. On the Russell, just a little bit of a lift, up by 0.25%. If you switch up the board, turn the page and push into the bond market, let's sit at the front end of the curve. The 2 years been all over the place, massive range, huge range, something like 40 basis points on the week so far from the lows of Monday to where we are at the moment. 4.03% is where the 2 year is. Yields going nowhere there. Coming in just a touch on a 10-year. We're down about 3 basis points, 395, just in and around 4% to end the week, with some encouraging data, encouraging, Danny, relative to the doom and gloom of Friday coming into Monday.
I think it's important we look at what that encouraging data is and how much we can get from it. Just as a whole thing, jobless claims have very low statistical significance. I mean, this is a really noisy piece of data. And even just looking at this one, the expectation was for 240,000. We were less by 7,000 people. 7,000 people in the entirety of America did not file for jobless claims, and we decided that the recession was over.
Yeah, basically, and moved on very quickly. And we're going to do it all over again next week. So if you don't like it, I don't know what to say. Jobless claims next Thursday. We're going to do it again. We said it yesterday. It was amazing to see how much weight people were putting on weekly payrolls, on weekly jobless claims. And it was treated as if it was the new payrolls Friday, jobless claims Thursday. Do you think that's going to be the case next week if things calm down enough to say that's not the story next week?
Well, the thing I'm concerned about is whether this is, we're searching for a new paradigm. We don't know where we are yet. Basically, the tails keep fluctuating and how much we care about them. So in that sort of environment, you get a really volatile market on every data point. Or is this just the summer? Or is it just because it's August and not a lot of people here and liquidity is really bad and so we're swinging around a lot? I think it's hard to distinguish between the two at this very moment.
Neil Dutt's taken a big step back, and I think we've all had to do that repeatedly through this week. I've lost count of how many times I've said that. Let's take a big step back. But let's take a big step back. Are things getting worse or better? And Neil Dutt of Ranmax suggesting things are getting worse. He actually said this. He put this out in the note yesterday, and I thought this was important. The economy is more or less operating at the Fed's year-end 25 expectations over a year ahead of schedule. But the federal funds rate stands over a full percentage point higher at the moment relative to the SEP estimate. Now, we'll get an update to the SEP in September, and maybe we close that gap. But that's a suggestion from Neil, like a suggestion we had from Bill Dudley, the former New York Fed president, earlier this week on this show, that this Fed, if it's offside, it might be offside by anywhere up to 100 basis points plus, depending on whose opinion you trust.
And that's why you get the commentary that they should be cutting 50 basis points, because they are so behind and they can catch up if they are willing. That is the big point of this, that even though the market's ahead of them, the Fed feels so far away from this conversation. Susan Collins, again, talking about this morning that she's still looking at inflation, that in order for them to cut, inflation needs to come down. The market has completely moved on from that conversation. It's moved on to employment, and the Fed continues to stay. We have more time, and there is no rush.
Dollar yen has moved on just a little bit as well. 147 on that currency pair, negative here by 0.1%, which means we can move on from dollar yen, at least for this morning, for this hour, for the next 5 minutes. Under surveillance this morning, Donald Trump and Kamala Harris setting on at least one presidential debate. The candidates agreeing to a September 10 meeting on ABC, with Trump offering further debates on Fox News and NBC. Bloomberg reporting Harris will decline the Fox event and only agree to other debates if Trump actually shows up on September 10th. So are we still debating about the debate, or have we moved on?
Well, both. We're not debating about the September 10th ABC debate that Trump had backed away from because he said he agreed to it with Biden, and now the Democratic Party flipped up their ticket. So he's back on for that debate. But he's saying that we need more debates. He already debated Biden. He's now going to debate Harris. So he wants two more, one on Fox News, one on NBC. And what we're reporting is that Harris does not want to go into the Fox News territory, but potentially after September 10th, maybe they could, goat her into another one.
Brett Baer's a pretty down-the-middle anchor. What are they worried about?
Not quite sure. And she's going to be president of the United States. It's going to be much more challenging people on the other side of the table, like autocrats, like dictators, than Brett Baer.
She's got the momentum right now, which I guess she means she thinks she can pick and choose. And Donald Trump in that campaign is trying to put pressure on the media, to put pressure on her to do more debates and more interviews. I found the language yesterday really quite vague. Have they agreed to an interview? Are they going to agree to an interview before the end of the month? Or are they just saying we'll schedule one before the end of the month, which could mean we get one after the end of the month?
I think they can. What she said is they're going to be there. She told her team she wants to schedule something, get in the books before the end of the month. Does that mean the scheduling is being done before the end of the month or the interview is being done before the end of the month? It was unclear to me. So clearly they are feeling some pressure, though, from the press corps, from the Republicans, like J.D. Vance going over to her press corps saying, why is she not answering any questions? As a journalist, obviously, I want more debates. I want more interviews.
Sure.
I want to understand policy. But you have to think, if you're a political strategist, why would you not just take every win you are getting if you are Kamala Harris, show up to the events where you know what you're going to say, the crowds are cheering for you, and you don't have to answer any policy questions?
Let's see how long it lasts. It's working right now, that's for sure. I'd like to bring you an update on the latest in the Middle East. The United States, Qatar and Egypt calling for a new round of ceasefire talks in Gaza. Israel saying it will send a delegation to the talks next week, while there was no response from Hamas. The US saying a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. And this is the problem for a lot of people like us from the outside looking in. It's like these two opposing thoughts simultaneously at any given one time. The prospect of this war could escalate, could spread across the region at the same time there's a prospect of a ceasefire. Altogether, currently that's the focus.
Well, that's why potentially you see the White House putting a lot of urgency on this ceasefire agreement, because if they were to get this over the finish line, potentially it holds back Lebanese Hezbollah and Iran from retaliating against the assassination of the Hamas leader. That is potentially one reason why we can see this urgency. I got on a call with a U.S. official yesterday following this for some background, because it was kind of weird coming from Sisi, coming from Sheikh of Qatar, coming from Joe Biden saying they've agreed on this date, August 15th. But that date is just to sit at the table to talk about these gaps that remain. Doesn't mean that next Thursday we're getting a deal.
That's the latest on geopolitics. Let's just take a beat and take a moment to get you up to speed on some sector news, some individual name news. Paramount joining Warner Brothers in running down the value of its TV networks. Yet another sign of weakness in the traditional TV industry. The company seeing sales at its TV networks fall 17%, while the company's streaming business posted its first ever quarterly profit. And that's why the stock is up in a pre-market by something like 5.6%. As we turn to healthcare, Eli Lilly posting its best day in a year after edging ahead of rival Novo in the race to dominate the booming obesity drug market. Debra Netschert of Jennison expecting the growth to continue for Lilly, writing this: thanks to a significant ramp up in manufacturing capacity, uptake is going to increase dramatically in 2026 to 28. This will translate into significant sales and earnings acceleration. Debra's joining us now to walk us through all of this and expand and give us detail, Debra, in a way that I think we've been lacking over the last few weeks or so. Welcome to the programme. I think for many people, and I'll speak for myself, when it comes to Novo versus Lilly, I don't know what the difference is, what the drugs are, and what the real distinction is between the two companies is, Debra. Can you help us with that? What is the distinction between those two firms and the treatments and the drugs that they're putting out to market?
Sure. Well, thank you very much for having me. It really does feel like they are part of the same conversation lately and thought about as one company, doesn't it? So Lilly is, we'll start with Lilly. Lilly is a little bit more of a diverse company than Novo. They have a huge business in diabetes and obesity, as we've talked about and as everyone knows, but they also have been incredibly successful in oncology and immunology, and are just launching a new drug for Alzheimer's. But because of the sheer size of the diabetes and obesity business, a lot of the rest of Lilly does not get talked about. The main drugs for Lilly are Zepbound and Mounjaro. Zepbound is marketed for obesity, whereas Mounjaro is marketed for diabetes. Novo is a little bit more of a diabetes pure play. They've had a very long, tenure in diabetes with a big insulin business turning to the GLPs. They have Ozempic for diabetes. They have Rybelsus, and then they also have Wegovy, which is their obesity drug.
Debra, I want to understand the difference between those obesity drugs themselves. For example, one of the big criticisms of Novo was you have this drug that comes out and it allows people to lose weight, but you have a problem where people are losing muscle mass, that in a way they're almost becoming less healthy because of that. Who is at the forefront of addressing that issue?
Well, I think the jury is out whether or not the muscle mass is really an issue right now. We need longer term data on obesity, which we don't yet have. I think the one thing that you should think about is we at Jennison really focus on the long term. And if you look at the long term data from diabetes, we're not seeing any adverse events related to this difference between muscle and fat loss. So I think we just need a little bit more time and a little bit more data to see whether or not this is a long-term issue with these drugs.
And in the meantime, I mean, the adoption and even just the addressable market for these drugs, Debra, is really big. Since the 1970s, the United States has had an uptrend in obesity rates. Are we about to witness a wholesale societal shift where for the first time really since the Great Depression that obesity rates are going to start to fall?
It would be really great if we could see that, because there is such a large downstream effect of obesity on other body systems. One of the most interesting things about the GLPs is just the number of different diseases that they are having an impact on. So we've seen a positive cardiovascular risk reduction in morbidity and mortality. We've seen an impact on liver disease called MASH. We've seen positive impacts on sleep apnea. We've seen positive impacts on kidney disease and other types of cardiovascular diseases. So hopefully as time goes on and these GLPs are adopted, we'll see this downstream effect take place. I think the thing to focus on is since the obesity meds have come out, we've really been supply constrained. And both Lilly and Novo have made really positive strides on supply and are going to be exiting 2024 with significantly more supply than they've ever had before.
There's been a ton of enthusiasm, but you say utilization isn't even close in terms of percentage of these drugs in the market. Where do you see this going in terms of percentage of, the next 5-10 years?
I mean, significantly higher than we are now. We're really still only in the single digits when you think about obesity. So we have a long way to go.
There's a lot of people, Debra, as you know, trying to develop second derivative trades around this story. And I just wonder, for you and the team, what the process is that you go through to develop those kind of trades. I can tell you from our perspective on this programme, we've had everyone from talking about the snack business all the way through to the airline business and talking about the savings on fuel costs, of all things, Debra, if the average passenger loses some weight. How are you thinking about those second derivative trades?
Well, when we think about the second derivative trades, we're really focused on looking at drugs that can actually move the puck forward, not really be similar to where we are now. The obesity market, we believe, is going to be incredibly different and segregated in lots of different ways in 10 to 15 years from now. And by that I mean there's going to be different types of drugs and different types of administration profiles and duration and timelines in which you take the drug for people that need to lose different amounts of weight. So there will be a lot more options if you need to lose 25% of your body weight or 10% of your body weight. There's going to be a drug for you. There's also going to be a lot of combination drugs for patients who have comorbid conditions. So we're really paying attention to companies that are going to be able to move the puck forward and find a differentiation. The thing that's really interesting is even Lilly, when they were on their second quarter call yesterday, talking about the amount of R&D that they are doing, that Novo's doing, they haven't stopped with neither of these companies have stopped with developing drugs and R&D. They are still pedal to the metal to try to develop the next best thing. If you look at what's happened with supply and just the sheer number of clinical trials, a newcomer coming into this market is going to need to spend a significant amount of money on both R&D and manufacturing to really play. So it's not only about, can you develop a drug that has weight loss that is better? It's what else does this drug do? How is it different than what we have? Is it more tolerable? Is the administration profile more favorable? And then also, can you develop a really broad phase 3 program and afford to develop a really broad phase 3 program to demonstrate efficacy across as many diseases as both Lilly and Novo have and are continuing to? And then can you build manufacturing and scale it up and build supply to really be able to be a meaningful entrant in this market?
Yeah, that's not easy at all. Debra, appreciate your time. I'm pleased we got to make this happen. I have no doubt we'll be talking again soon. Debra Netschert there of Jennison Associates. BMI is an imperfect measure of things. It's just height relative to weight. We all know that. Standard definition of obesity is a BMI over 30. More than a third of Americans have a BMI over 30. I think we know the addressable market here is absolutely massive. What I heard there at the end is how difficult it will be for others to compete. And when we talk about winners, particularly in places like AI, we're talking about a handful of names potentially. It feels the same way in this sector as well.
That's literally exactly what I was thinking, that the innovation economy has gotten to which in the US, that the things we're trying to address take huge amounts of spend, take huge amounts of research. And I think if you're an investor, for example, looking at this market saying, how do I play this? How do I play innovation? You keep going to the same names. And there's a reason behind that. And it's in order to keep spending, you have to have the cash to do it. And if you're just a pull yourself up by your bootstraps startup, you can't do that anymore.
It's why Novo quickly became the biggest company over in Europe. That's the latest on this front. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Microsoft said a group of hackers linked to the Iranian government tried to breach email accounts of presidential campaign staffers as part of a wider effort to gain intelligence ahead of the U.S. election. The company revealing attackers linked to the Islamic Revolutionary Guard Corps used a compromised email address from a former political advisor in a phishing attempt on a high-ranking campaign official. It follows a warning from U.S. intelligence officials last month that Russia, China, and Iran were recruiting people in the U.S. to spread propaganda. Iran has denied that allegation. China has a new richest man as its thriving e-commerce sector continues to gain ground around the world. Temu founder CEO Kellen Wang's net worth climbing to $48.6 billion, pulling ahead of bottled water mogul Zhang Shangshan. The 44-year-old's staggering rise has been fueled by China's changing shopping habits and what's been referred to as a trade loophole, allowing Temu's small packages to enter the U.S. duty-free. And U.S. track star Noah Lyles took bronze in the 200-meter before announcing he tested positive for coronavirus, ending his Olympic run. Team USA also making a comeback against Serbia in men's basketball. Steph Curry helped push the team to the gold medal game against France. As for the medal count, the U.S. continues to lead in gold medals and total medals, followed by China and Australia. That's your Bloomberg brief. John?
Massive game Saturday afternoon. Yahara, thanks for that. Up next on the programme, the bullish case for bonds.
The consensus positioning was for a bearish steepening. I look at it now and I wonder, where's all that gone? The next move in rates is unambiguously down. The question is how much?
We'll get into that question up next from New York. This is Bloomberg TV. Equity's just about okay, slightly negative, rolling over in the last 10 minutes or so, but no real drama here. We're down almost 0.1% on the S&P. The rally in bonds picks up again. We're down about 4 or 5 basis points on a 10-year, 394.17. Under surveillance this morning, the bullish case for bonds.
1 month ago, we were talking about reflation trades and various scenarios around the election, and the consensus positioning was for a bearish steepening. I look at it now and I wonder, where's all that gone? The next move in rates is unambiguously down. The question is how much? The market tends to lead the Fed, and I think you're seeing validation of that now.
So here's the latest. Treasury yields lower after a wild week of swings. Meghan Swiber of Bank of America writing the following. We revised lower our 10-year rates forecast from 4.25 to 3.75 by the end of the year and now expect a greater degree of curve steepening. Meghan joins us now for more. So, Meghan, let's follow that and welcome to the programme. If you're looking for the 10-year yield to drop, say, 20 basis points from where we are currently, where does that curve steepening come from? How much of a move are you looking for at the front end of the curve?
So, John, when we look at how the curve evolves historically, when we get these much bigger steepening moves on the yield curve, it happens when we observe a notable uptick in the unemployment rate, when we're looking at scenarios around harder landing. So, indeed, we are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent.
When I hear a 10-year yield is coming lower and then I also hear steepening, I'm thinking, well, it must be coming from a bull steepener, right? You must be looking for an aggressive move at the front end. And the next step of my thinking is, well, you must be looking for a big move from the Federal Reserve. Is that not right?
Not exactly, John. So our house case at B of A is that the Fed will deliver 2 25 basis point cuts this year. So that is pretty well below what we see a lot of economists on the sell side calling for. And at some points this week, less than half of what we saw the market pricing in terms of the degree of cuts. So we can be looking at seeing the curve steepening evolve. But what we're going to see a challenging environment for right now as well is thinking about the supply picture at the back end of the curve. Deficits are really only going one way. So a lot of the curve steepening that we're anticipating is not so much coming from the bull case for rates notably falling, but seeing more of the steepening pressure coming from the 10s, 30s part of the yield curve.
Interesting.
So, I mean, in that, you could say maybe this week was evidence for that. You get a 10-year and a 30-year auction, and both of them don't go well.
Yes.
Do you think that was behind it, or was it just, you know, we kind of added a lot of bonds leading up to it?
So I think it's kind of twofold. What we saw really from a number of different investors was everyone was very much so calibrated in the soft landing camp. And what's involved in that is looking at trading 10s within this range of 450. The data that we got last week, the payrolls data, generally the more sentiment data pointing to this picture of maybe there are some risks here around this soft landing, caused a pretty decent bid for duration. So people came into the market and said, well, maybe this 4% level is not the low that we can get on 10s. Perhaps we can see duration really outperform more so. So we had a very strong flight to treasuries, the global risk-free asset class, the end of this week and the end of last week and start of this week. And we saw a little bit of a lightening up, I think, in terms of that conviction and duration on some of the more positive data that we're seeing come in. A bit of a whiplash here for rates markets.
Okay, so when does the supply picture come back in then? When do we start worrying, and when do we get more auctions like we did this week?
So this is the tricky dynamic here, right? When we have greater conviction in the harder landing outcome, there's no absence of demand for Treasury securities. As I mentioned, right, Treasuries play this incredibly important risk-off role in portfolio allocation. When we're thinking traditionally about what insulates us from large equity drawdowns, it's nominal Treasury rates, right? But if we now settle into more of this soft landing probability, that demand becomes a lot more conditional on the yield levels that we're thinking about. And the very important question there, too, is what rate level is the Fed going to cut to at the end of the day? We had the market pricing Fed getting to below 3% this week. That's well below what we're expecting from our house call at B of A.
Can we sit on supply just a little bit longer?
Please.
We have noticed this shift since last November to a lot of T-bills.
Yes.
What's your expectation now for what issuance will look like, where they'll sit across the curve, where they'll push all that issuance out in the next 18 months or so at Treasury?
So we heard refunding that Treasury is now thinking about considering this higher bill share going forward. So TBAC, which is the group that advises Treasury on its issuance strategy, had previously been saying, Treasury, you want to target between 15 and 20% of bills. But what we've seen, and you talk to retail investors, you talk to a variety of different clients, everyone wants to still be in bills. Everyone has increased their bill holding share. We still see very strong inflows into money market mutual funds, and why wouldn't you? Because that's the point in the yield curve that is still yielding the highest. So Treasury right now has recalibrated this. TBAC has said, look, we can see this bill share remaining above 20%. So on a go-forward basis, Treasury is saying, well, bills are elevated right now versus what we've been looking at relative to longer-term history, but they have an appetite to keep that bill share higher. That doesn't mean that they're not going to grow coupon supply again at some time, right? We are absolutely seeing expectations for deficits come up through fiscal year 2026. Certainly election risks around deficits coming in even higher. But right now, Treasury is saying we're going to be tactical with our issuance strategy. We don't want to oversupply the duration component.
Just before you go, so I've got this number in mind for next time. Where do you see the 30-year yield in the next 12 months?
So we do see 30-year yields relatively range-bound to what we're looking for. So it really is, John, more of this story for greater potential and appetite for the rest of the yield curve to rally relative to the 30-year part of the curve. Generally because that's where we're going to see the greatest demand for duration coming from. To buy the 30-year part of the curve, you really are thinking about pensions, much longer-term investors. And we have this interesting thing in the rates market where when yields go down, the funded status of a lot of these pensions also go down, and they don't have that same appetite to buy longer term duration.
Meghan, this was awesome. So range bound at the longer end, everything else rallies a little bit, steeper curve.
Exactly.
Perfect. Meghan Swiber at Bank of America. If only it was that easy, of course, but that's the expectation. Coming up, Binky Chadha at Deutsche Bank, George Ferguson of Bloomberg Intelligence, David Mericle of Goldman Sachs, and Dirk of Citi. All of that still to come. The third hour of Bloomberg Surveillance up next.
The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago.
The labour market deterioration, if it continues, well, then that could feed and create a downward spiral.
We think the Fed right now is pretty far behind. It's at a very restrictive level right now.
They are ridiculously behind the curve, irrespective of what the capital markets are doing.
The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The Bears have loved this, haven't they, over the last week? They've absolutely loved it. Let's see if they've got anything else to love over the next few months or so, but they're loving it at the moment, that's for sure. Equity futures on the S&P 500 totally unchanged. Let's get you to the weekend with futures going nowhere on the Nasdaq and likewise on the Russell. Looking ahead to the opening bell about 90 minutes away. We're already looking ahead to the month ahead. PPI next week, CPI after that, retail sales. Next week's absolutely packed, and then it's on to Jackson Hole with Chairman Powell addressing not just Jackson Hole, Wyoming, not just this country, but I think the world as well, Danny. Addressing global markets at a time when Fed officials, I have to say, do not look like they are scared, worried, do not sense urgency and need to move quickly. Never mind 50, they're still talking about whether to go 25.
Well, I'll tell you one crowd he's certainly addressing is the Bank of Japan, whether he means to or not. You know that Ueda, the deputy governor, all of them are going to be listening with bated breath to see what happens. But yeah, the Fed has a different conversation going on. They are still talking about this idea that they have more time, that the labor market, it's only that people are not hiring, it's not people being let go, and that gives them time. That gives them time to wait. The concern is if you're waiting, are you too late by the time that layoff starts?
The good news for the Fed is that they don't have to mark to market every day. If they did, this would be even more wilder, even more vicious, even more volatility than we've already had. If you take stock of the data, though, it's like a tale of two different weeks, two very different weeks. Manufacturing last week, some payrolls data, really soft. Services this week, some jobless claims data, much firmer. How balanced are things right now?
Well, the issue is, though, when you look at the services data underneath the hood, if you look at what companies are actually saying, they're pretty much saying it's normal. It's not great. It's just leveling out. And they also talk about how there are some concerns when it comes to these companies about how some consumers are waiting on the sideline until after the U.S. election. And then you hear what the earnings calls are talking about. And you do hear corporations say that they are seeing consumers pull back a little bit or trade down. And I was struck this week with the Disney CFO said to us, well, they're not traveling right now, but we think they're going to come back to us.
Paul Donovan of UBS, I think, put it quite well, made it very, very simple. When it comes to unemployment, if you start to fear unemployment, you start to behave very differently. And there are a range of opinions out there about where we are in that process right now. Paul has taken a much more constructive view of things. Others think that process has already started. That fear is starting to set in. People will pull back. Companies are identifying that. Once companies identify that, they go to protect margins. When they do that, cut costs, and then you cut labour, so on and so forth. Have we started that process yet?
Well, margins, certainly, you feel the pressure from companies. And to your point, that's when you start looking at cutting, even if we're just in a scenario where people can't get a job at the moment. And that's the thing. That is something that does slowly grind at sentiment. If you're jobless right now and you can't find a new job, that of course will hit your sentiment. It's kind of the whole like frog in the boiling pot. Are we just starting to turn up the temperature? And it will start to boil at some point.
The heat going up just a little bit more in the last month or so, that's for sure. Equity futures on the S&P then pulling back by 0.1%. I said things were pretty stable out there. The bond market's running a touch. We're down 4 or 5 basis points on a 10-year at 394. On dollar yen at the moment, going nowhere. Get us somewhere, but basically nowhere. We're down 0.2% on dollar yen at 146.94. Coming up on the programme, we'll catch up with Binky Chadha at Deutsche Bank as stocks rally on easing labour market concerns. David Mericle of Goldman Sachs on the odds of a US recession, and Dirk of Citi saying don't blame the carry trade. We'll get into that in a moment. We begin with our top story, the big issue, the S&P 500 leaving behind a week of volatility and looking to build on its best day since 22. Binky Chadha of Deutsche Bank staying focused on the earnings and remaining positive. Growth for the median company has continued to pick up, indicating a broadening out across stocks. The gap in growth between mega cap growth and tech and the rest has shrunk. Binky joins us now for more. Binky, it's good to see you.
Yeah, good morning.
Walk me through what you expected from earnings season and whether things have played out more broadly as you expected.
Yeah, I'd say on the S&P 500, a little bit weaker than we expected, but you know, what we expected is not always the most important thing. If you look at it from quarter to quarter, we've gone basically from an 11.5% year-on-year growth rate in the first quarter to 11%. So, I mean, earnings, you know, are volatile. Things don't move in straight lines. So I would say overall, you know, growth momentum is basically hanging in. And, you know, one thing to keep in mind about that 11% is that it's actually, you know, it's average growth outside of recession. So it's neither high nor low is the way that I would put it. I would say much more important is basically what's been happening under the hood. Yep. So coming into earnings, you know, we have an equity market that is basically positioned very, very long, coming entirely from overweight positioning in mega cap growth and tech, and average or below average, which means underweight positioning in the rest of the S&P 500. Now, positioning tends to follow and tends to align basically with earnings. And if you look at positioning for the mega cap growth in tech stocks, you know, market was essentially positioned for rip-roaring earnings growth to continue. So keep in mind that the fourth quarter of last year, we had 40% growth. First quarter, we had 39% growth. So the market was really positioned for that to continue, if not accelerate. And we and the bottom-up consensus has been basically looking for a slowing in growth. And you know, so far, I mean, NVIDIA hasn't reported yet, but we have slowed from 38% to around 28, 29%. So that's a pretty significant slowdown, while earnings growth for the S&P 500 has sort of hung in at 11%, despite this big slowing in growth coming from mega cap growth in tech. And if you look at the rest, earnings growth has picked up, but the pickup is modest. So the gap is shrinking, but most of the shrinking is happening from one side. Our disappointment, what we were expecting was a slightly bigger acceleration in the rest. If you take the rest and you divide them into two, there's energy and materials, which is one of the reasons for why earnings growth has hung in, because we've just gone from minus 25% in the first quarter to minus 3 or 4%. We were looking for plus 5%. And for everybody else, you know, it's just kind of normal variation hanging in rather than any big pickup.
As you know, the last few months have been absolutely ridiculous. I think you only have to go back a few months when it was good news was bad news, because we were talking about the prospect of another interest rate hike from the Federal Reserve. That was a story of bad news is good news, and now that's switched on its head. We're in this more sort of like intuitive world where good news is good news and bad news is bad news. And I have to say, even over the last 6 weeks or so, Binky, let's go through it together. We've had a rotation at the expense of tech. We had a broadening out that included tech. Then we had this risk aversion driven by bad economic data. We had this other bout of risk aversion driven by the unwind of the carry trade. Yeah. What regime are we in right now? What is this?
I think, you know, the one thing to keep your eye on is all of this started basically with an equity market that was positioned very, very overweight, as I said, pretty lopsided. And you fast forward the tape at the end of this week, as of yesterday's close, positioning has gone basically from the tippy top of the Z-score band, close to +1, 96th, 97th percentile. Positioning has been cut to below average. The market is now underweight equities. And that, of course, you know, is very, very constructive for the market going forward. It does depend on the catalysts and the like. And again, going under the hood, it is positioning in mega cap growth and tech that has been cut. It's still on the high side, but it is aligned with the kind of 28, 29% earnings growth that we just got in Q1. So I would argue, the fundamental reason basically for the pullback, which is positioning was too high relative to kind of earnings growth and, the rotation that needed to happen. That driver looks like it's pretty much done. So now it does depend on what happens on all the other fronts that you mentioned, and I'm not going to list it.
Please don't. No one needs that.
It's only in 4 days. Yeah.
Well, I mean, the thing people are talking about, like, oh, it's healthier now, right? Like, it's healthy that positioning on mega cap tech has come back. It's healthier that we finally have had some sort of drop in this equity market. That it's normal to have 5% drawdowns. Mm-hmm. But how healthy and normal is it to have the biggest company in the S&P 500, NVIDIA, one day lose $130 billion in market cap, and then the next day gain $150 in market cap? Is this a healthy market by that measure?
So you're going to have this issue whenever there's a new technology or, something big is happening. So, I mean, if you just think about growth rates for companies, the question is really how long is that cycle basically going to last? So yes, the earnings growth is slowing from 500%, but it's slowing to 400% and 300%. Those are, unbelievable growth rates after they've slowed. So the market, yes, I mean, we will have the volatility there because it changes the entire outlook depending on how you think about the cycle, basically.
We've been talking about all the data that's coming up next week in the road to Jackson Hole to hear from Jay Powell. But you mentioned NVIDIA. Is that actually the more important data point we should all be focused on, their earnings at the end of August?
So at the end of the day, my view is the anchor for equities is earnings. We can deviate from time to time, but so earnings are absolutely, very important. But we've gotten most of the earnings, so I don't really expect the broad picture to change very much.
Binky,
as a result.
favorite sector right now, what is it? What do you like?
I like the financials and the consumer cyclicals. I would say financials, still have to price in the new higher rates regime that, we don't know what the probability is of going into recession, but I would put my money on the other side that we are not going there. Both of those are very supportive. We are at a point in the cycle, so this is a very, very, very unusual cycle, but if you have a scorecard of the things that have happened and the things that need to happen still
Everything's
in a typical cycle, now loan growth hasn't picked up yet. It typically lags basically economic activity for a while, and I would say 2022, which was a while ago, is still sort of playing a role. So we have basically loan growth yet to come.
Hang on a minute, just pause. Can I jump in?
Sure.
Just quickly. You think in this cycle we're still due another pickup in loan growth?
Absolutely. It tends to follow economic activity, tends to overlay with the ISMs. Where are the ISMs? They're sub 50. It's one of the data points you mentioned. I would argue, it's totally in disconnect from 2.8% GDP growth in the last quarter. The Atlanta Fed, last time I looked yesterday, was at 2.9% for this quarter. Loan growth will come back. It is one of the aspects of the cycle that is still missing. Number two, I would say we just had 1 quarter of a pickup in CapEx, but typically in a cycle, you have a pickup in CapEx. I can go on. There is a long list of things that I would argue.
What I hear from you, Binky, is you think this cycle can continue.
Absolutely.
Much longer than people think.
Absolutely.
So what we've priced in...
Despite Monday's price action.
Well, let's talk about Monday. So we're pricing in aggressive action from the Federal Reserve. You want to fade that?
I would fade that. And in my outlook for equities, it does not figure prominently, what the Fed does, one way or the other.
What's the price target now in the S&P for you, year-end?
We had a range coming into the year. We picked the top of the range is 5,500. We are still there. I think it's very possible that the S&P goes higher, basically. Year-end is a point in time. I would say we are still, in the midst, basically, of a pullback. If you think about the calendar, we have the presidential election coming up. The market tends to focus a month before, so that would be the first week of October relative to a typical first week of November election. We have, though, an important, and the equity market pulls back by 4 to 5% typically. Now, things have changed. We have early voting starting in a month, so does that change basically the issue? And of course, we have, severe geopolitical risks in the Middle East, I would say, that we need to be watchful about. But both the election and geopolitical risks, the question is, are they going to alter the business cycle? And it is only altering the business cycle that would alter basically the path of equities. If you look historically, neither has done that most of the time.
A bullish take for you going into the weekend. Binky, it's good to see you. Thank you, sir.
Thank you.
Thank you. Binky Chadha there of Deutsche Bank. Futures just a little softer here. We're down 0.2%. The opening bow just around a corner. Let's take the opportunity. Let's take a beat and get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump and Kamala Harris appear to settle on at least one presidential debate, with both candidates agreeing to meet on September 10th in a debate hosted by ABC. Trump said he had also agreed to debates on Fox News and NBC. And according to an anonymous campaign official Bloomberg spoke to, Harris will not agree to the Fox News debate and will only agree to future debates if Trump shows up to the ABC one. Paramount Global saying it will cut about 15% of its workforce, amounting to about 2,000 jobs, as it prepares for its merger with Skydance Media, the parent company of Nickelodeon and MTV, reporting earnings that beat Wall Street estimates yesterday after the bell, after its streaming division, like Disney, swung to its first ever quarterly profit. But like Warner Brothers Discovery, Paramount took a second quarter impairment charge of $5.98 billion on its cable networks, marking another sign yet of weakness in traditional TV. And a large majority of economists see only a quarter-point decrease in interest rates coming in September. That's according to a Bloomberg survey. The finding is at odds with calls from some of Wall Street's biggest banks for a jumbo cut at the next Fed meeting. Nearly 4/5 of respondents predict the central bank will trim rates to a range of 5% to 5.25% at its September 18th decision, with most of the rest predicting a larger reduction. Fed officials have pushed back on the need for aggressive actions. That's your Bloomberg brief. John?
Yahara, thank you. We'll hear from Yahara one more time again in about 30 minutes' time. Up next on the programme, we'll get you some morning calls as we count you down to the opening bell, about 1 hour and 14 minutes away. And we'll catch up with Bloomberg's George Ferguson as the new CEO of Boeing walks the production floor. That conversation up next. As we get closer to the opening bell, we're pulling back just a little bit on the S&P 500, down a little more than 0.1%. In the bond market, yields continue to fall this morning, down by about 4 basis points. 394.55. If you want a dollar yen check, not doing much. We're down about 0.2%. A slightly stronger Japanese yen, 146.94. That currency pair moving basically in line with the move we're seeing in risk elsewhere, particularly in equities. That correlation still sticks, but we're just not seeing a big move so far this morning. Let's get you some morning calls. BMO raising its price target on Eli Lilly up to 1,101, pointing to its exceptional leadership and recent expansion in manufacturing. That stock is up another 1.2%. Next up, Wolfe Research upgrading Truist Financial to peer perform, saying the company is well positioned to benefit from changes in the macro environment. That stock is down by about 0.6%. And your third and final call from Morgan Stanley, upgrading General Dynamics to overweight, highlighting its impressive balance sheet and strengthening demand for defensive products. As we stick with the aerospace industry, Boeing's new CEO, Kelly Ortberg, taking over, pledging transparency in a bid to turn the company around. However, Boeing facing a new scandal potentially, NASA warning the Starliner may not be able to bring back 2 US astronauts from orbit. Bloomberg's George Ferguson joins us now for more. George, before we get to the new leadership, let's talk about the new crisis, if we can call it that, and I'm not sure we can call it one just yet. What is happening with this expedition?
Yeah, so it seems that the capsule that Boeing built is having problems with thrusters. And I think there's a debate right now between Boeing and between NASA whether or not it's safe enough to bring the astronauts back from orbit. As you probably know, if you don't get the orbital re-entry right, I mean, it can be catastrophic. And so I'm sure NASA is being very, very conservative, as they should be, with spaceflight. And they're talking about potentially bringing the astronauts back with a SpaceX capsule in February. So, and Boeing looks Boeing's had problems with this capsule before. They had problems on the initial docking, even without astronauts on it a while back. And so it's been a bit of a burr in their saddle. It's not big to their financial results, but it's definitely been a burr in their saddle. And I think just indicative of the challenges of the company in sort of engineering and quality.
Yeah, George, it feels like we've been treating it as two different things. The things that you're saying are linked together. Could this get to a place, if we're not talking about until 2025 when the astronauts are coming home, that it's more reputational damage for Boeing? It's more damage that maybe the White House needs to look into and the Congress people on Capitol Hill?
It is. I think the country wants a strong Boeing, right? They're part of the defense, establishment. They're part of our space programs. You don't want single vendors, right? In this case, they've selected Boeing and SpaceX to be the vendors for capsules going to the space station and other work in space. When you have one breakdown, you lose your redundancy. So I think it's definitely something. And the FAA is already looking into their quality challenges in their factories.
So Boeing is dealing with defense issues, the space unit issue, as well as what's going on with commercial jets. George, if this new CEO walking the factory floors, what is he going to be most focused on the next 6 months?
I think it has to be, again, quality coming through those through the factories, right? If some of the reports we heard out of like Spirit Aerosystems for the second quarter was Spirit built, they said a rate of 31 a month, so they built maybe 93 737 fuselages. The number that got delivered to Renton, Washington to be manufactured into airplanes was 27. That rate is horrible, right? And so that's Spirit Aerosystems, but that's going to become part and parcel of Boeing, and that's part of the problem they've been having. It's really about improving quality in their factories. I think that's number one, so that they can start to up throughput, improve cash flow, improve their perception of quality with their customers. And I think it's getting back to a strong engineering culture, which I think is indicative of what you have here with the capsule.
Absolutely massive challenge ahead of them, that's for sure. The stock is just about positive in early trading. George, appreciate your time this morning, sir. George Ferguson there of Bloomberg Intelligence, the latest on Boeing. The opening bell about 1 hour and 7 minutes away. Just a reset here for you. Equity futures on the S&P coming in just a little bit by a couple of tenths of 1%. Lots of takes on Wall Street over the last week or so. This came in from Michael Hartnett of Bank of America this morning. Wall Street, painfully, he says, has now stopped BOJ hikes. Wall Street's next goal appears to be bossing the Fed into big interest rate cuts. Real rates for small businesses are too high. Big cuts are needed to avert a hard landing. Buy the assets, Danny, strangled by 5% yields that breathe more easily, with yields at 3 to 4%. The call from B of A.
But he continues to go on to talk about this idea that, like, maybe we're not fully done with this thing yet, that maybe there is more pain to come. And talking about the market bullying the Fed, again, I come back to this interlink between U.S. stocks and the Bank of Japan, and even what we're seeing today. And I can't help but wonder if we have this kind of backwards, this idea that it was the yen appreciation that essentially set off U.S. stocks. The carry trade, by some degree, is just a low volatility trade. So what if we are in this new environment where every time you see volatility in the stock market, it scares people out of the carry trade? So we could be, every time you see the VIX spike up, you see some problem with the yen, and it's kind of a new weird reality we might have to contend with.
JP Morgan also coming out with a note saying that stocks remain more at risk for severe declines because the Fed is just not showing that urgency. And they say this, I think we all know this, stocks don't just go up, but they say equities are no longer a one-way upside trade, instead increasingly a two-sided debate on growth and downside risk. And that's really been the point of this week.
We've definitely seen some two-way risk, that's for sure, over the last couple of weeks. Up next on the programme, we'll catch up with David Mericle of Goldman Sachs. We'll speak to Dirk of Citi. Goldman coming out over the weekend and really pouring freezing cold water over the prospect of a 50 basis point interest rate cut in September. So we'll get into the reasons why. For Dirk over at Citi, you'll like this, Danny. We do not think that the carry trade unwind was a major reason for the US equity market swoon. He points to other reasons.
Yeah, I'm so looking forward to this. He says, look, it's about the economy. It's about the U.S. economy, and that's the issue that we've seen that equity markets play out. But, I mean, did we just, again, get ourselves tied up in psychology that we think they're linked, so they will be linked?
Yeah, and that's kind of how the week's played out, particularly around the Japanese yen. We'll pick up on that story in just a moment. The view on the economy from Goldman Sachs, the view on the market from Citi, all of that still to come from New York City. You're watching Bloomberg Surveillance. Equities on the S&P, negative here by, let's call it 0.25% on the S&P 500. On the Nasdaq 100, down by 0.4%. Losses building just a little bit, but it's been calmer this morning, so far at least, and that's for sure. And there's not a big catalyst later on in the day exactly. There's no big data point. There's no big earnings that we're expecting. There's not a lot of Fed speak. And if you take stock of all of that so far this week, Danny, Fed speak, there's a real lack of urgency about cutting interest rates anytime soon. If they're going to, it sounds like 25, and that's basically it at the moment. When it comes to the data, that was better than expected. If you think about the BOJ, they've backed away from the prospect of hiking interest rates anytime soon. Earnings, some weakness, consumer weakness here and there. Saw it in Disney, but nothing new. I wouldn't say we've got new information this week at all.
No, we haven't, and that has allowed the market to basically come back right to where it started. Equities on the week after these insane swings are just down as of the close yesterday, 0.5%. I mean, did Monday even happen? It kind of feels like it hasn't. It feels like we're back to square one. And again, this is where you get people concerned. And Neil Dutta talks about this, that we are off sides now for a week next week that is heavy in data, and we could flip right back to being nervous about the economy.
I'll tell you this, Danny, for a lot of people in this market on the wrong side of some of these moves, they felt like Monday happened. And they're still feeling it. So like bruised and battered over the last few days or so. Let's turn to the bond market. Monday definitely happened. The 2-year dropped to 365, which is just ridiculous. We're about 40 basis points higher now, 4.02% on a 2-year. We're down about a basis point. On a 10-year, 394.17. We're down about 4 or 5 basis points so far. We'll give you a check on dollar yen. It's been an important feature of this market over the week or so, last week or so. 146.81 is where dollar yen is at the moment, down about 0.25%, just a touch more yen strength, in line with this pullback we're seeing in risk in the equity market. As I say, though, correlation still sticks, Danny, just not a big move this morning like we saw earlier this week.
I just find the interplay between these two so interesting, and that's why I'm really excited to talk to Dirk Weiler of Citi, because he says that it's not the yen that's moving equities around, it's about the economy. But these two have become so closely related, and we've heard so many people say people are using the yen to fund trades in tech, but we kind of can't tell how big it is or who is doing it, or how long they're going to continue doing this. You kind of get people throwing stuff out there saying, we're kind of halfway done with the unwind. We're 3/4 of the way the unwind. You get the feeling?
Who knows?
Nobody.
So much of this, we've said it's like the weather. It's like, where are we now? Which way's the wind blowing? That's what it feels like. Under surveillance this morning, former President Donald Trump saying presidents should have more say over interest rates and monetary policy. Trump telling the media from Mar-a-Lago he may have a better instinct. Powell has pledged not to let politics influence his or the FOMC's decision. Question is, if Donald Trump comes back into power, does he have a different plan?
Well, there was a report in the Wall Street Journal in April that they were looking at plans to potentially try to blunt some of the Fed's powers. And then every single someone related to the current Trump campaign or former official would come on this program or behind the scenes. We would ask them, where did this report come from? Everyone threw cold water on it. But now the president is coming out and saying, actually, I think I should have influence because I have a better sense of the economy and I have a good gut feeling. Paul Donovan this morning. We heard from him earlier with UBS. We heard from him earlier, not about this, but he said this in his note. He's like, these retro policy proposals, he's obviously talking about what happened with Richard Nixon. He says they're not serious. He said, but if they were, if this was the market taking this seriously, actually, you'd potentially see the movements in this in the market. So right now, everyone's just viewing this as potentially just rhetoric.
This would damage, without a doubt, the US dollar. If that's the objective, I think that would work. You'd have a real problem on your hands. If people started to believe, and it would take a lot, you'd have to really change things for people to start to believe this, but if people start to believe that we were going to have the politicization of central bank decisions all over again, if we were going back to that world, you'd start to see some big moves in foreign exchange.
But the thing is like, I don't understand why people aren't taking this at least a little bit seriously, because everything Trump has said, from saying he wants a weak dollar to yesterday, I mean, all you have to do is look back to his first term. When he appointed Powell, he said he did it because he expressly wanted a Republican at charge of the Fed. And so maybe that didn't play out exactly as he wanted. Maybe he thought Powell would listen to him more, but this isn't a new idea from him.
No, and we're going to hear more of it potentially in the months to come when people actually ask questions and he answers them, because that's what happens. And that didn't happen yesterday at all with Kamala Harris, did it? You got an opportunity to ask a question. You ask questions about asking questions.
Yeah, she walks over to the press corps, rips off her sunglasses. What you got for me?
What you got?
Will you answer questions?
Oh, my goodness. That's actually what happened yesterday afternoon.
That is what happens. But there was a lot of pressure growing on the Republican side, on the press corps. Obviously, every journalist is asking her for a sit-down interview. But they're not going to yet. She wants to introduce herself. I don't think you probably see her sit down until after the DNC.
Why don't the press pack understand this? That you build on each other's work, so that when you have the opportunity to ask questions, the person next to you follows up and asks questions and you stay on topic. Why does that never happen in Washington? Why do we never see that
It does happen.
at all?
It does happen with some press corps. It does happen with Secretary
Foreign
Blinken's
policy.
foreign
it happens
policy
with
does.
foreign policy. Like this sounds so critical. The rest of them, I never see it. If you have the vice president come over to you and there's a group of you and she comes up to you and says, what have you got? And the first thing you say is, when can we ask questions? Like, when can we do an interview? That's ridiculous.
No, they could have went down the line with a few policy questions we're all asking for. I did speak to someone in the Trump world yesterday, and I sent them the quote from Trump about his feeling of the gut and what the Fed thinks. And they said, well, what does Kamala Harris think about the Fed? And I was like, I don't know yet.
Hopefully someone asks and we'll find out. Let's turn to mortgage rates, plunging in the United States, hitting their lowest levels since May of last year. Freddie Mac saying the average for a 30-year fixed home loan is hovering around 6.47%. Rates topped 7% earlier this year. That's the latest on mortgage rates. For the consumer, very much in focus in the next week or so. Investors looking ahead to PPI, CPI, retail sales and earnings from Home Depot and Walmart. David Mericle and the team over at Goldman Sachs raising the odds of a recession, but adding the Fed has room to react. Quote, we have increased our 12-month recession odds by 10 points to 25%. We continue to see recession risk as limited, not only because the data look fine overall, but also because Chairman Powell emphasized the Fed has room to cut. David joins us now for more. David, good to see you, sir, and welcome to the programme. You guys poured freezing cold water over the prospect of a 50 basis point cut in September. It certainly feels like the economy and the data we've had so far this week has moved your way. How dependent do you think the September decision is on the data between now and September 18th?
I think the August employment report will be very important. Our expectation is that the July employment report will turn out to be a bit of an outlier, that the weak job growth number, the 0.2 increase in the unemployment rate, that we won't see the August report look as weak, that maybe job growth will be closer to 150,000, and that if that turns out to be right, that the FOMC will decide that the right calibration is 25 basis points. But we think 25 basis points at consecutive meetings to start, which is a little bit faster than what they were planning before. They were previously planning quarterly. So that would be one step up in the speed. To get 2 steps up in the speed to 50 basis points, I think you would need to see worse data than we've seen so far. Historically, the Fed has only done more drastic things like intermediate cuts or 50 or 75 basis point cuts when there was either some sort of crisis going on or when jobless claims were much, much higher than they were today. So that in both cases, you felt like you needed to act aggressively right now in order to stop things from getting worse rapidly. I just don't think we're there right now.
David, that's the path. How have your thoughts evolved about the destination? What do you think the end point is for interest rates?
We haven't changed that. We continue to think 3.25% to 3.5%. Now, that would be 100 basis points above where the hiking cycle stopped last cycle. So that's very different. But this has been one of our core house views at Goldman Sachs going back a decade plus, that neutral is not and never was quite as low as the conventional wisdom held last cycle, that we were dealing with the aftermath of a financial crisis. And as in every country in history that has dealt with that, there are long-lasting headwinds that are separate from monetary policy that hold the economy back. But things like private sector deleveraging and disruptions to financial intermediation and fiscal austerity, those were not literally permanent. They lasted for years, but they were not permanent features of our economy. And I think now we're learning that it's not been as devastating to have these higher interest rates as many people thought coming into this hiking cycle. And so I think gradually over the course of its framework review, the FOMC will discuss these issues. And my guess is they'll wind up being content with stopping higher than they stopped last time.
So, David, what changed for you after the Friday jobs report? We certainly see the outcome of it, that not a huge recession risk, but still you upped it to 25. So what change happened?
The main thing that I took from the employment report is now from the labor market report is now the unemployment rate is up enough that it didn't feel right to say that the 12-month recession odds are just the historical unconditional average of 15%. That's where we had been for about the last year. Last fall in 2023, we went down to 15% because we felt like the inflation scare is behind us, the regional bank scare is behind us. Of course, there are always things that can go wrong, but I didn't really see any risk that looked particularly elevated. Now we thought it's not quite fair to go that far, so we bumped them up a little bit, but we are very much still on the optimistic end of this debate. Our 25% odds are lower than consensus, lower than I would perceive investor sentiment to be, and our growth forecast for the year at 2.3% Q4 and Q4 is still very much above consensus.
The Fed is still optimistic at this point too, David. All you need to do is look at Barkin yesterday saying we have more time and layoffs aren't happening. Instead, it's just a slowdown in hiring. Is he right? Do they have still a lot more time?
I think it's very difficult at the moment to disentangle labor demand and labor supply. I think what we know is we had a huge immigration surge that peaked in the back half of 2023. So at some level, job growth should have gone up and it should be coming down. We simply don't have enough workers entering the labor force every month to create the 250,000 jobs a month we created in 2023. So I think that is a lot of it, but in fairness, it is difficult to know in real time what is too weak of demand, what is just kind of the natural decline in supply, especially given all of the uncertainty about the level of immigration. So I would agree, right now, things don't look so problematic to me that I think they need to be aggressive. But what I would say is they ought to be, and I think they will, erring on the side of caution if we do get additional negative data. I'm not really concerned at all about inflation staying too high. And so if there is a concern about the labor market, if we do get a weaker August employment report than I anticipate, then I think they probably should and probably would be more aggressive.
David, good to catch up with you. Appreciate it. David Mericle there of Goldman Sachs on the latest, their view on monetary policy from the Federal Reserve, looking for 25 basis points, 25 basis point cut from the Federal Reserve in September. Here's a take for you. We do not think that the carry trade unwind was a major reason for the US equity market swoon. The words of Dirk Willer, the global head of macro asset allocation over at Citi. And Dirk joins us now for more. Dirk, wonderful to get into this with you. If it wasn't that, what was it?
Yeah, no, very good question. But I think often, you're supposed to go with sort of Occam's razor theory, right? You look for the most simple explanation. And I think the most simple explanation is everyone was in the soft landing camp until Friday. On Friday, the NFP hit. People were questioning that belief, thinking, well, maybe it is a hard landing after all. Well, if that happens, you do two things, right? You sell equities, or at least you reduce equity risk to some extent. And at the same time, because US rates are falling, dollar yen goes straight down. I mean, that's the strongest correlation we have in markets for a long, long time. That dollar yen is mostly driven by US rates. So you quickly get to both of these effects as two big consensus trades, right? The carry trade and the equity trade, both being consensus trades, being undermined by a point of US data. And that's in the end caused both of these things. So I think that is the most simple explanation, the most likely explanation. Now, what I would say is the yen move certainly had something to do with the sell-off in Japanese stocks. I mean, that is, I think, quite clear, because the main reason for Japanese stocks outperformance is really a higher dollar yen. So if you question that assumption, you also question Japanese outperformance, and that had an impact. But on the S&P, I think it's an old-fashioned case of worries about hard landing going up.
So if the dog is the growth scare and the tail is dollar yen, I've got to ask you whether the tail starts wagging the dog a little bit here, Dirk, and whether enough people now just believe dollar yen is that important for risk appetite in America. Is that the current regime?
And certainly there were lots and lots of questions about the yen, about the carry trade from equity investors. If you talk to FX investors, they think it's really unlikely that FX is wagging the sort of global equity markets, while equity guys are very open to the idea. So it's certainly the case that the focus on dollar yen has increased a lot. But I think in the end, right, what's going to happen is that we will not be able to quite figure out whether it's a soft or hard landing for a while. We need more data. Citi is actually in the more bearish camp, and our economist is looking for a hard landing. But in any case, I think even the soft landing proponents think basically that the way to get to the soft landing is early and more aggressive Fed cuts. So that means US rates will not make it back to where they were before Friday, and even in a soft landing. And that also means that dollar yen will not make it back to where it was before. And so I think we just have to get used to the fact that, yes, we have a very different handle now for dollar yen. and the yen could stabilize around here, but will not move higher again in dollar yen terms. And that's how it is. And I think markets will move on from the focus on dollar yen over time.
Dirk, I really feel like you should have gotten over to Japan and talked to the BOJ, because I think they could have had this talking to, because I think they thought it was squarely in their hands. Hence, you have the deputy governor come out and say, we're not going to move when markets are volatile. I know it's a whiles away, but does that mean when we get to September 20th, the BOJ has a decision, we shouldn't be worried of this happening all over again if they hike rates?
I do think historically dollar yen depends more on US rates than on Japanese rates. And the reason is that US rates are a lot more volatile. And so if you think dollar yen is driven by the difference between Japanese and US rates, it's usually US rates that are in the driver's seat. Now, if you get these BOJ hikes, then clearly they take precedent for a few days. And clearly the BOJ hike mattered a lot for dollar yen, and it mattered a lot for Japanese equities. So that is true. I mean, I would think that the hurdle for Japan to go again has really increased very considerably, and that's for two reasons. One, the issue is that we get more Fed cuts than we were thinking, at least in Citi's view, and earlier Fed cuts. And that means dollar rates will remain very well behaved, and that means dollar yen will not be a problem for the BOJ anymore. And dollar yen is extremely important for inflation in Japan. It really is one of the major contributors. And if that is not a worry anymore, just fundamentally the BOJ will be not under that much pressure to move. Don't forget, they also move partly because of political pressure where the weak yen became an issue for the government. So that is all gone. And that is important. The second issue is, of course, that there is some blame that will be passed around. And, you know, that if your equity market in Japan crashes, sort of the moment you hike rates, you'll think twice before you do it again. So, and we had these comments, as you mentioned, that were along those lines. So I think the BOJ will be very, very careful going forward. Historically, they were never able to hike again when the Fed was in an easing cycle. And so I do think, obviously, we still debate whether it's a U.S. hard landing or U.S. soft landing. In a U.S. hard landing, the BOJ will probably not get another hike in. In a soft landing, it's more debatable, but they will be very, very careful going forward.
Citi does, though, think that there's one trade that potentially could be squeezed by the unwind in global carry, and that's the yuan. Where are we with that unwinding?
That's a very good question, because if we look at our flow data to try and understand how much of the carry trade has been unbound, which is, of course, a key question, certainly for FX investors, then what you find is the high yielders, which are the long side of the carry trade, meaning your Mexicos and your Brazils and so forth, they have been cleaned up tremendously already. And that started to happen in June, right after the Mexican election. So that is not a concern anymore at this stage. Now, on the funding side of the carry trade, meaning mostly Asian currencies, the cleanup has been much less far advanced. On the contrary, people really added to that trade even after the Mexican election. So interestingly enough, I don't think FX investors were very much positioned for a higher dollar yen. I think that was already pared back very significantly after the interventions and after US rates started to change direction. However, to be long dollar CNH has been probably the most popular trade in FX on the long dollar side. And the reasons, of course, that it was a combination of carry plus a Trump trade. And both of these things have become, of course, somewhat more shaky. The carry unwind after the yen move, and on top of that, Trump's probabilities having come down as well. And there we still see very meaningful positions. We still think that going into the election, once the election trade comes back, which it has sort of disappeared from investor conversations almost for a little while, given what was going on. But once the election trade comes back, people will again be very happy having long dollar CNH positions, and CNH should weaken into the US election. But positioning remains an overhang and might have to clean up further first.
Hey, Dirk, enjoyed this. Let's do it again soon. Dirk Willer there of Citi. So is it the dog or the tail? Where are we at? Did we agree on all this?
Like, I feel like it's not even an animal. It's just this like messy ball of things like
Okay.
rolling around, impacting himself.
An identified object.
An unidentified object. You know, the moves from the BOJ didn't cause the market moves, but the market moves are impacting the BOJ.
Got it.
And so if that's where we are,
I think.
Okay, well, basically, because the market moved, the BOJ can't act, right? And we were saying, okay, like the BOJ has a really small window. They can't move when the Fed is easing. From what I'm hearing from there, that window never existed. Like the BOJ could never go because as long as we think there's a chance of a recession, sorry, BOJ, you can't hike because this is what happens.
And can the Federal Reserve cut? Because if the Federal Reserve cuts, then we just exacerbate the pain in dollar yen.
You know, you exacerbate the pain in dollar yen, and then equities sell off, and then
Right.
it's more restrictive.
I don't get
See,
it.
it's a mess. It's not an animal. It's a crazy,
Amoeba.
weird. Yeah, it's an amoeba. Perfect.
And an identified mess. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. The U.S., Qatar, and Egypt are calling for a new round of ceasefire talks, the latest effort from the Biden administration to end the war in Gaza. Israel said it will send a delegation to the talks scheduled for next week, while Hamas did not respond. U.S. officials now say a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. The Federal Reserve could soon begin easing interest rates if inflation continues on its downward path, according to Boston Fed President Susan Collins. In an interview with the Providence Journal, she added that the U.S. labor market remains strong even though the latest jobs report came in softer than expected. Collins expects interest rates to be lower in the next few years, though of course she stopped short of providing a precise outlook for the timing and pace of easing. And Michael Hartnett of Bank of America says volatility in global financial markets has yet to reach the levels that would signal worries about a hard landing. He wrote in a note that while investor feedback is frazzled, expectations of Fed rate cuts mean that a preference for stocks over bonds hasn't been ended by the market rout. Hartnett has taken a more neutral tone on stocks this year after remaining bearish through a rally in 2023. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning and have a great weekend. Up next on the programme, setting you up for today and a sneak peek of next week from New York. You're watching Bloomberg TV. The opening bell 36 minutes away. Equity futures going into it slightly negative. Near session lows, actually. We're down by about 1/3 of 1% on the S&P 500. The rally continues in the bond market, resumes, picks up, however you want to describe it. Yields are lower by 5 basis points, 393.41 on a 10-year. We've talked a lot about dollar yen. Is it important? Is it not? It's important to a lot of you, so we're all looking at it. Dollar yen 146.70. We're negative on that currency pair by 1/3 of 1%. Just a little bit of yen strength going into the weekend. Here's the trading diary going into the weekend for today and a look ahead to the calendar for next week as well. Today, Vice President Kamala Harris on the campaign trail in Arizona. Donald Trump heading to Montana before an interview with Elon Musk on Monday. Tuesday, US PPI data followed by Atlanta Fed President Raphael Bostic. Wednesday, the latest CPI print. Thursday, retail sales, plus another round of jobless claims. And more Fed speak through the week from a select host of Federal Reserve officials before Jackson Hole the following week. Danny, I've got to say next week, all about the data.
Kind of scary. And like the best thing you could have done for this week was get jobs on Friday last week and literally shut everything down. Shut everything down, go away, go to the beach, because we ended up right back where we are. How volatile are we going to be next week? Is it going to be the same thing where it's a pendulum swings from data point to data point and we end up exactly back where we are? And that is, I don't know, and things are uncertain.
And with inflation coming down as potentially the trend, this was supposed to be a moment for politically this White House to really triumph. We finally are in a place where things are normalizing because this is one of the top issues. But how difficult is that when every day you have people coming on the program talking about growth scares and the R word, this potential recession?
3 pieces of good news for you. 1, things have settled down. 2, Lisa is back next week. 3, I'll be away from the desk for a week. So you have a wonderful weekend and I'll catch up with you soon. From New York City, up on Monday, Neela Richardson of ADP, Terry Haynes of Pangea Policy, Tony DeSpirito of BlackRock and Jane Foley of Rubberbank. All of that still to come. From New York, this was Bloomberg Surveillance.